We're trying to diversify the tech trade.
It's all part of that rotation story that we're talking about.
We need almost those big tech companies to be performing well and delivering.
The opportunity set for small caps has become a bit more narrow.
The net of everything is that it seems to be more about positioning, valuation, and sentiment recalibration, not a deeper growth scare.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday with tech bouncing, 2 days of gains pushing stocks within striking distance of all-time highs. As AI demand is driving TSMC sales to grow at the fastest clip in months, Alphabet is attracting more than $100 billion of orders for a $20 billion debt sale. That debt binge is going global.
If $100 billion worth of orders isn't enough, well, how about a 100-year slice that you got being sold over in the United Kingdom? Look, if this was a test about how much appetite there is, both domestically and globally, for big tech giants to push out and build out some of their AI dreams, well, it is a resounding clapping sound coming from capital markets. Will this extend to the others, or is this an Alphabet-specific story? Really remains to be seen.
Let's go with the 100-year issue. Let's talk about that. Sterling is a natural denomination for an issue that long. Got it? There's some demand out there. That's the good stuff. A tech company is not the natural issuer. Typically, we'd be talking about countries or universities. This is unusual and something we've not seen since the late 90s.
Since 1997, when I believe Motorola sold a bond issuance at the peak of the tech.com bubble. A real question here about which institution is going to lock in their obligations, their need to get repaid by a company that is tied to the latest and greatest going on in artificial intelligence that's changing month to month. So it raises this issue. How much demand will there be? And is this the peak of the market? One portfolio manager in a Bloomberg story was talking about how 100-year bond issuances tend to indicate the peak.
These are huge numbers and they're being taken down really, really well. So maybe this could go on longer than we expect. And maybe it could generate some really big growth figures. This big, I don't know. This comes from the President of the United States, that if Kevin Walsh does a good job with the leader of the Federal Reserve, then maybe we can grow at 15%, and I think more than that.
I think more than that, he said. More than 15%. You know, annually we grow, what, 2.5 to 3%. I don't know if the president is talking about cumulative of his 4 years and beyond. Really unclear what he means when he says 15%. But what is clear is that the president is once again sitting for an interview. Clearly there is concern about the idea of affordability. Americans are going out and spending, but prices are still higher, and they have a concern for this. So he's addressing it, and he continues to, I'm sure, sit for interviews and maybe try to tell the American people how they should feel.
Before he's even confirmed, before even he sits in the chair, the first day of the job, the bar for him just got a little bit higher. The bar for the data's high too. Retail sales later on this morning, and then we get the big one, payrolls tomorrow, claims on Thursday, CPI on Friday.
What are we going to expect from this data after what we heard from Kevin Hassett yesterday? And I think the market reaction is more interesting even than the comments that were not clarified. Kevin Hassett, the chief economic advisor to President Trump, was talking about how you can expect worse labor market data coming out. He was talking in general, although maybe people view this as a tell that he'd already gotten the data. He was talking about the productivity boom and lower immigration numbers. The fact that the market took this as numbers coming in worse than expected highlights where the market's bias is and what the response could be if we get a really disappointing number.
And no big change in the estimate so far. The estimate for tomorrow morning is 68K. That's the median estimate in our survey. The range super wide. We talked about that a few times. At the high end, 135. At the low end, negative 10K. Coming up this hour, we'll catch up with Marvin Lowe of State Street, with stocks sitting near all-time highs. Francis Donald of RBC as investors brace for key economic data. And Meghan Robson of BNP Paribas on big tech's massive push into the debt market. We begin this hour with stocks on the brink of all-time highs with a slew of data on deck. Marvin Lowe of State Street writing the following: we still find the current environment remaining conducive for risk. Rotate America, not sell America, which puts treasuries and the dollar most at risk. Marvin joins us now for more. Marvin, good morning.
Morning.
15%? For the year ahead? No, you're pushing back?
I don't know what accounting he's using.
What kind of GDP figures are you and the team looking for?
Yeah, exactly. I mean, trend growth is 2%, right? We're above trend growth for the last several quarters. We have a tendency to underestimate the strength of the U.S. economy, but double digits.
You know why people are bullish, though. Maybe not that bullish, but bullish. Yeah. And it's because we've already had rate cuts from the Federal Reserve.
Sure.
There's tax-free funds to come through the next several months.
Absolutely.
And we're looking at just 4 companies with capex intentions of $650 billion. And when they come to the debt market, the market's taken it down really, really well. Is it hard to fade that story?
I think it is hard to fade the story. It might be hard to, plow more into it at this point, but I don't think you're fading that story. And ultimately, we are seeing the rotation that seems to be getting a lot of attention over the last couple of weeks as a healthy rationalization of where you're supposed to put your money into the markets.
I'm stuck on the 15% and this idea that potentially, not necessarily we're going to get 15%, but it indicates the way that President Trump and some of the advisors are thinking about the United States, which is in some ways an emerging economy. In some ways, this is a not developed market that sort of has a staid growth rate. And I just wonder if there are broader implications of that kind of lofty goal for the way that U.S. assets are treated, given some of the volatility and the fact that people have increasingly looked at some of the budget as well as the potential coordination between the Treasury and Fed as emerging market behavior, not necessarily a developed market one.
Yeah, I mean, that's a great analogy. And it certainly is a conversation that I think everyone's had over the last year where, the developed markets have become the emerging markets. And in a lot of ways, the restraint that we see out of the emerging markets are making them the better behaved children in the room, if you will. It does speak to the risk parameters that you demand on assets in a market that is talking that way. And administrations that ultimately want to try to push that type of agenda. For sure, there is a cost for that volatility.
Why are we not seeing it in terms of the bond auctions that we're getting? We're getting some Treasury auctions this week. We've got a lot of U.S. companies that are raising debt overseas. It doesn't seem like that premium is getting baked in any material way. Is that going to shift?
Yeah, you know what? I do think that the dollar is weaker than one would normally expect with the type of growth environment that we're talking about, and long yields are higher than one would expect during a cutting cycle. The fact that we're looking at 10-year yields, particularly from a curve perspective, widening out into this cutting cycle is somewhat unique. But regime change-wise, it takes time. And I think that you have the factors that might be driving it, but the catalysts have yet to materialize. We're all watching it, and we're waiting for whether or not we're really dealing with a new regime. But for the moment, you have to give the Fed, the whole financial system, the benefit of the doubt that you can't really avoid these asset classes.
Well, the president weighed in on Kevin Warsh last night, saying that it was his runner-up in the first time, and then when asked about what's going on with the DOJ investigation and whether it was worth it to have this investigation, if it means it's holding up the nominations, he basically was like nonchalant. If it happens, it happens. How are you thinking about a future Kevin Warsh-led Federal Reserve? Do you think he's going to come in and be dovish?
You know what? That's pretty much the conversation that everyone's been having for the last couple of weeks. His history is the exact opposite. The way I see it, whether it's the fact that policy setting occurs within a committee and he's one vote, and the balance sheet discussions and ultimately, a Fed Treasury type of accord where we talk about potentially less Fed buying at the long end, all of that is a higher yield. So, for me, it still is a duration neutral and potentially steeper curve type of discussion that comes out of all of this.
The president was also saying how he's been fighting with Senator Thom Tillis for a while, which is why he's retiring. Do you have any concern about independence of the Fed?
You know what? Yes, we always have concern. Having said that, the Federal Reserve Act has withstood the test of time. I do think that the market will quickly punish absolutely bad policy. There's a difference in credibility. If they're cutting by 25 basis points, and there's disagreement around it, that's not necessarily independence. If you're actually saying that you're going to go to the zero lower bound while inflation is 3 to 4% and accelerating, that's bad policy. It gets punished, and it immediately makes its way into the financial markets.
2s versus 10s right now, 70 basis points. There's some steepness there. Not that steep. What kind of number have you got in mind?
I've got and I've had on this program in particular for quite some time, somewhere around the 120 range. Historically, that is not overly steep. And when we talk about regime changes, we really do need to think through several cycles, including before the GFC, when the curve was more naturally steep.
Is that driven by the front end or the long end?
It's driven by a bit of both. So a bear steepener or a bear twist as part of that discussion.
How quickly can you actually start seeing that come to fruition? So we hear this from a lot of different people. The yield curve should be steeper. You should have an extra yield premium on the long end. We haven't really seen it come to pass, especially when you see sort of how immune the long end yield curve has been to even some of the volatility we're seeing in Japan. So what's sort of your explanation of what hope people are holding on to before that starts to really materialize?
Yeah, I mean, treasuries are this incredibly interesting asset class within the world, and it's not as if anybody is incented to sell aggressively around it. It's really a function of when they buy less. And I think we're starting to see those types of conversations emerge. Do we continue to see less foreign interest in the U.S. markets because there are 100-year bonds that they could buy elsewhere? That is kind of the iterative process around how we get there. But it really does make it difficult if you're playing a trade and you expect duration outperformance because the Fed is cutting. We haven't had it, and I wouldn't expect it.
Do you think Alphabet exists in 100 years?
The history of 100-year bonds, and I haven't been around for all of them, but is not necessarily great.
Marvin, thank you, sir. It's good to see you. Marvin Lowe there of State Street. If you're just joining us, we're looking for the pricing from that sterling-denominated 100-year issue coming out of Alphabet. We'll get more for you later on this morning. Let's give you an update on stories worldwide with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Good morning, John. President Donald Trump says his pick for Fed Chair, Kevin Warsh, will be able to drive the U.S. economy to a 15% growth rate. Trump says Warsh was the runner-up in his last search for a Fed chair, and it was a big mistake to pick Jay Powell, who was pushed by former Treasury Secretary Steven Mnuchin. Warsh's confirmation may be delayed due to the Justice Department probe into the Fed building's renovation. Meanwhile, as y'all were discussing, Alphabet's raising $20 billion in its biggest ever U.S. bond sale. This as the tech giant sells sterling and Swiss franc denominated bonds for the first time today, including a rare issue of a 100-year note. Sources telling us here at Bloomberg, Google's parent company is offering 5 tranches each of sterling and Swiss franc notes. And we're seeing TSMC shares rising in the pre-market. The chip maker reporting a 37% increase in revenue for January compared to last year. The manufacturer for tech giants like Nvidia and Apple benefiting from a surge in AI spending. The company pledging to spend as much as $56 billion for the year, up a quarter from 2025. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, high expectations.
We should be at 15% if our new head of the Fed, who I think is going to be great, but if he does the job that he's capable, we can grow at 15%. I think more than that.
Good luck, Kevin. Terry Haines of Pangaea Policy joins us next. Live from New York City this morning. Good morning. .30 Eastern Time, look out for US retail sales, the first in a string of data points for the week ahead. Retail sales later this morning, payrolls tomorrow, claims Thursday, CPI on Friday. Under surveillance this morning, high expectations.
We should be at 15% I'll tell you, if our new head of the Fed, who I think is going to be great, and he's a really high quality person, but if he does the job that he's capable, we can grow at 15%. I think more than that. Look, I've been fighting Tillis for a long time, so much so that he ended up quitting.
Here's the latest this morning. President Donald Trump setting sky-high expectations for Fed Chair nominee Kevin Warsh. Pressure building to get confirmation hearings underway. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, sky-high maybe understates it. 15% growth.
Yeah, John, at this point, it's probably an understatement to say President Trump was trying to shed some light here on his hopes for an anticipated Fed Chair Kevin Warsh. It is unclear if the president was referencing year-over-year growth or some other metric, but underscores what could be intense pressure for the next Fed chair if and when he is confirmed. Now, perhaps behind this very rosy target is the fact that we are heading into the midterm elections, and that is going to be putting some pressure, heightened pressure on this White House and Republicans, considering that they are still playing defense when it comes to the economy. A new poll out from Pew Research finds that most Americans view the economy negatively. In fact, 7 in 10 of them are saying that right now they view it as fair or even as poor. Now, the White House appears to be banking on monetary policy under a potential Fed Chair Warsh as helping to fuel the economy forward. And they're also pointing to some of their other key policy proposals, including that they're expecting larger refunds this tax season under the One Big Beautiful Bill, as well as the president's continued push when it comes to onshoring manufacturing. But at this point, John, it really does feel like it is all about that defense game for the GOP heading into November. Now, if President Trump feels that Kevin Warsh could help advance Republicans' economic agenda, he may need to let up that criticism of the current Fed Chair, Jerome Powell. When asked directly in this interview whether or not the Department of Justice's investigation into Powell was worth delaying the confirmation of Kevin Warsh, President Trump said, quote, "If it happens, it happens." And then, as you heard, he went on to say that he has long feuded with Senator Thom Tillis. Tillis, of course, had voted against the One Big Beautiful Bill last year. So, John, at this point, it appears that we are still at this stalemate.
Tyler Cantor with the latest in Washington. Tyler, thank you. Joining us now, Terry Haines of Pangaea Policy. Terry, a few comments now, one from the President, another from the Treasury Secretary over the past few days. Do you think that maybe they're starting to acknowledge these confirmation hearings won't be happening anytime soon?
Oh, I think they understand that from the get-go, John, frankly. And it's not so much Thom Tillis's signal. The real tell here is Senate Banking Chairman Tim Scott, who, by the way, is the head of the Republican Senatorial Committee this cycle. So he's also in charge of getting the Senate, reelected and staying Republican. And there's a situation here where, last week Scott came in basically and confirmed everything Tillis has said, and essentially offered the White House a deal. We'll get your confirmation done, indicating strong support for Kevin Warsh, but you've got to get rid of this investigation sooner rather than later. Trump has no qualms about telling the Justice Department, who works for him, what to do or what not to do in any other circumstance. So at some point, he's going to have to tell U.S. Attorney Pirro to get on with this or be done with it.
Well, the fact of the matter is he's not doing that yet, Terry. Why?
Well, I don't know that he is or isn't. He isn't announcing it on Truth Social, if that's what you mean. But he might well be doing that behind the scenes. There's two kinds of conversations that happen in Washington. One kind is loud and squawky. The other one doesn't seek press attention. So for all I know, they've told the U.S. Attorney to figure out what she's doing here and be done with it one way or the other. The other reason, though, I will say, in closing, though, is something that Besson keeps bringing up, which is that the Fed could have been investigating cost overruns, could have been investigating itself for quite a while, and hasn't. He keeps bringing that up both in terms of the building renovation, in terms of Cook, and I think that's a sticking point with the White House, that the Fed needs to self-police a little bit more than they already have.
Terry, if we do, though, get into a scenario where we do not have the DOJ investigation wrapped up, how do you foresee the Fed being run? Does Jay Powell just stay on? Does the President of the United States have the authority to appoint someone?
Well, they can designate, but Pyle, I think, remains the chair until somebody else takes the chairmanship, frankly. I mean, that's the way it usually works. That's how I would expect it to be to happen in this case. The market's effects of that, of course, would be to increase Fed uncertainty around interest rates and other matters.
Terry, if I were Kevin Warsh, I would not be sad, given the holdup in potential confirmation. Based on some of the recent proclamations coming out of the White House, if Kevin Warsh is responsible for 15% growth rates in the United States, what does that kind of Fed policy look like?
Well, I imagine the president's talk here is entirely rhetorical. My last night look showed that the two highest growth rates post-World War II were 8.7% in 1950 and 7.2% in 1984. So 15% is entirely rhetorical. I think that's about the midterms, as Tyler mentioned, and I think that's also, frankly, about the kind of the interlinking of national security and economic security. You can read that how you want to in terms of domestic politics, and that's pretty obvious. But people outside the United States hear that as, Trump is pushing absolutely as hard as he can to make the United States as big an economy, as dynamic an economy as possible. And sure, 15% is out of the question, but what if he gets half that? And half that's certainly possible, as I say.
The last countries to get 15% growth rate or above were Guyana and South Sudan. Others in recent history include Libya and Iraq. I was looking at this morning because I was trying to understand what kind of dynamic usually fosters this type of growth, which goes to sort of emerging markets versus developed markets. Developed markets tend not to really grow at that kind of pace. And I just wonder what this means for industrial policy, what this means for fiscal. Is there anything on the agenda that could actually get through to goose some of the growth ahead of those midterm elections?
What markets anticipate and have anticipated for some time is what you have, and we're in progress with this now to some extent. What you have is you have the one big beautiful bill last year. I anticipate, and I keep telling markets, I anticipate a second big beautiful bill coming up this spring. There will be no stone unturned to try to stimulate the economy as much as possible. And meanwhile, what you get is a lessening and a rationalization of regulation, which is happening all over the place in Washington. So if you get that, you certainly get a more stimulative situation overall. Again, I wouldn't worry about 15% or anything else in particular. I don't think you take Trump literally on this, but what you do take from it is the idea that they are focused as much as they can be on making the economy big, not just for domestic policy, but for international policy, for defense policy.
Hey, Terry, it's always good to catch up with you, sir. Thank you. Terry Haines there of Pangaea Policy. Growth is good, has been good for quite a while. GDP is good. That number is high. The character of growth is the problem. It's not resonating with Main Street. It's not sufficient enough to turn around the story when it comes to the polls and the surveys, asking people how they feel about the labour market because payroll growth has been so muted. When we sit here and talk about growth coming from the capex spend of 4 big companies, that's meaningful for GDP. When you see the capex coming from the tech sector, it's not meaningful when you, Mitch, or the conference board goes around and does a survey.
It's not meaningful when you don't see necessarily the job increases that come alongside this, because a lot of the biggest companies are not employing huge swaths of people. They are trying to accumulate land. They are trying to accumulate fiber. They're trying to accumulate chips that are sold by, guess what, TSMC, that they're going to get from Taiwan. So you put this together, and I wonder, even if you have a 15% growth rate, does that trickle down in the way that people are hoping for? Or is this ultimately a different type of tenor to growth that isn't going to deliver the results in time for that midterm election?
That's the political problem, and it's why the populists and the proposals they have are polling so well at the moment, not just in this country, but elsewhere too.
It's global. We're actually in a populist wave right now. And when it comes to this country, you see the President of the United States actually look to the far left for some of their ideas that he is promoting ahead of the midterm elections. You know, on the Google earnings call, what the CEO had to say is what keeps him up at night is compute power. You know what? I bet that keeps the president up at night, because what do you need for compute power? Land, electricity bills. All of this is a problem for everyday consumers.
There are things that markets care about and things that everyday Americans care about. And I just wonder when the two stories, because it is a matter of when and not if, when the two stories converge, the remedies to the kind of things that Americans care about could be the story that constrains the kind of things that markets care about.
If you start to get maybe a shift away from the deregulatory kind of overhang, especially if there's a focus on things like electricity and land use, people are expecting the bottom to come up to the top. They're expecting the trickle down from wealth effect. They're expecting the trickle down from some of this CapEx plan. So far, it still hasn't come out in a significant hiring or significant sentiment boost.
Stocks are close to all-time highs. A few tenths of 1% away. Equity futures this morning up by 0.1%. Up next, we'll catch up with Francis Donald of RBC as the focus turns to the data. Plus, Yahaira has your morning movers on semi falling as first quarter guidance falls short. Their stock is down by more than 4%. Equities positive, just about up by 0.1% on the S&P, following the biggest two-day rally on the S&P 500 of the year so far, adding about 2.5% to the benchmark and putting us within striking distance of all-time highs on the S&P 500. Elsewhere, the Russell small caps up another tenth of 1%. Switch of the board and get to the bond market. The news out of China and Japan threatening to push bond yields higher, and then the headline from Kevin Hassett pulling yields a little bit lower. We're down another 2 basis points this morning. It's a break of 420, 418 into payrolls tomorrow, whereby I think a lot of people might be on a bit of edge right now, following the comments from Director Kevin Hassett at the NEC that maybe we should look for a smaller than expected number, but you shouldn't worry about a smaller than expected number.
Yeah, don't panic, which makes people think, okay, this is going to be really bad. And it seems to be where people are primed. The fact that people had such a knee-jerk reaction to go back to bonds tells us two things. On one hand, you could say, well, it still has a safe haven attribute, regardless of some of the concerns about China selling and about a Japan fiscal policy that is a little bit more expansionary. Okay, that's one side of things. Second side of things is, how primed are people to buy on bad news? How much is this market going to be caught off sides if this economy is not as robust as currently priced in?
What is a good number?
Exactly.
What is a bad number? In this payrolls report in the next 24 hours. Retail sales later this morning, 8:30 Eastern time. As yields came down, the dollar weakened. The worst day, the biggest one-day drop for the US dollar of the month so far. Let's turn to foreign exchange. We unwind some of that move, but euro dollar still around 119. Euro dollar this morning down by a tenth of 1%. As we count you down to the opening bell and that data, let's get you some single names to morning movers. Yahaira has more. Hey, Yahaira.
Hi, John. There's been a lot of pressure on software companies like ZoomInfo to prove they can keep up in an AI-driven world, but ZoomInfo's results gave little comfort. The company signaled revenue could barely grow or even fall in the year ahead, so that anemic growth plus the risk of AI disrupting companies like this one is causing shares to plunge more than 10% in the pre-market. Meanwhile, also falling are on semi shares. They are down nearly 5% in the pre-market after its outlook came in a touch lighter than expected. This is a company still dealing with an inventory glut, and on top of that, slower EV sales are adding pressure to the chip maker, which is highly exposed to the auto sector. So it is increasingly looking to AI data centers as a new source of growth. And speaking of data centers, we end on Credo Technology. This is a company clearly benefiting from the AI build-out. It supplies data centers with cables, and it gave a preliminary forecast for third quarter revenue that absolutely blew past analysts' estimates and its own forecast. Listen to these numbers. It expects revenue of up to $408 million, far surpassing the $345 million it was previously guiding for. So shares are up more than 17% in the pre-market. John?
Yahaira, thank you. Thanks for the update. More from Yahaira later this hour. On our radar this morning, Alphabet launching bond sales in sterling and Swiss francs. Sources telling us here at Bloomberg the offer includes the first 100-year note by a major tech firm since the dot-com era. The bond sales follow a $20 billion deal in the United States in the last 24 hours. Elsewhere, shares of Taiwan Semi rising in the pre-market after reporting a surge in revenue for January. The company eyeing $56 billion in capital spending this year as demand for data center chips remains strong. And finally, the Trump administration reportedly planning on shielding hyperscalers like Amazon, Google and Microsoft from upcoming chip tariffs. The Financial Times reporting the carve-outs are tied to TSMC's commitment to build more semiconductors right here in the U.S.
And tied to our commitment to be the leaders in the AI wars of 2026. I think that there is a real question, about how much some of these tariffs are going to go into effect. A very small subset have actually been implemented. But on a larger level, using national security arguments for something that you can then waive on equally national security arguments on the other side saying that we need to build out so quickly seems to undermine some of what we mean when it comes to national security. And I'm not just talking about from a legal perspective. I'm talking from a market understanding perspective. What does national security mean if it can be lifted based on competitive edge when it was put on for competitive edge? It is a very complicated kind of understanding.
Because they want the manufacturing to come back to the United States, which is why this is tethered to you can only get the rebate if TSMC is coming to the United States to build some of these fabs. What I found interesting is an official speaking to the FT says we're going to be monitoring what unfolds like a hawk. Basically, you're not going to get the tariff rebates if we don't see that TSMC is building in the U.S. Basically, they do not want this to be a giveaway to that company. So that's why this is a carrot and stick approach. And also, it hasn't been decided yet. We should note that.
We're monitoring the data like a hawk. A slew of economic data through the week, kicking off with retail sales in about 2 hours' time. Francis Donald of RBC writing, there will be no shortage of growth in 26, but it will be growth for markets, not growth for the people. Francis joins us now for more. Francis, good morning. Good to see you.
Good morning.
That's a really strong statement. What do you mean by it?
It's a strong statement, but it's factual. This is jobless growth that's coming through into America. It's growth that's driven by CapEx, government spending, big emphasis on the supply side of the economy. But that's not necessarily a bad thing. This is not an economy that requires a significant amount of job growth behind it. So effectively, what we're trying to emphasize here is that we're used to an environment where growth is a rising tide that lifts all boats, not so in this particular environment. Despite these high growth numbers that are likely to come through this quarter in the next few months, you are still going to see the issues that have weighed on Americans over the past few years persist. So relying on the growth number as a savior, a panacea for all that ails America, that's what we're indicating is a little bit dangerous in this environment.
What do you think is a good jobs number at the moment?
Anything above 40,000. That's our estimate of the so-called break-even employment number, although that is continuing to decline. So when we hear Kevin Hassett say, get used to lower numbers, but don't panic, an economist's take on that, or this economist's take on that, is, well, this is not an economy that requires a significant amount of job growth. We probably need about 40,000 jobs per month, although that number is declining. So anything above that number is going to reduce the unemployment rate. And that's how you end up with this dichotomy of slower job growth, but an unemployment rate that could decline to 4.3%. At least that's our estimate.
Yeah, Kevin Hassett said don't panic. And panic is a different kind of emotion, especially given the fact that the market has not been panicking on some of these jobs numbers. And frankly, that nuance has been highly baked into a lot of outlooks from a lot of Wall Street houses. I just wonder, what's a bad number? And I'm talking not just about the headline number, but also the benchmark revisions that we're going to be getting as well.
Well, our take is that if you want a job in America, you're probably going to be able to get one, particularly in the healthcare sector. So it's not so much the headline number that I care about, but the composition. We've seen weakness in trade-related sectors, for example. And moving forward, we're going to have to really change our mindset. For a long time in this industry, if you wanted to guess the American economy, you would say, is the consumer employed? The consumer is going to be employed in America. What will matter is not do they have a job, it's do they have a big enough wage to offset the inflation that is in the system? Is it a good job? Does it help them keep up with the cost of living? So no longer is my estimate of how well the American consumer doing based on the unemployment rate. It's going to be based on the quality of those jobs going forward. And that's the re-education that needs to happen when we think about jobs numbers.
We were just talking about some of the tariffs that have put on semiconductors and others in order to bring manufacturing back to the United States. And one of the reasons why some people are getting really excited about small caps right now is because you are seeing the ISM manufacturing index turn up, which is typically a forward-looking indicator. I just wonder, are you starting to see the labor market in the manufacturing sector start to pick up as well? Is this going to be an employment-full type of resurrection of the manufacturing industry?
Not yet. In fact, what we've seen from other indicators like the ADP is actually that manufacturing sector is still contracting or showing some weakness there underneath the surface. So yes, good news. We do have some momentum under that manufacturing side of the economy, but it's not translating to jobs yet. Again, this is jobless growth that's happening under the surface. I'm not sure if it's don't panic. It's be aware that that's okay in this particular situation, but don't expect the employment side of this growth equation to surge to the same extent as you would see the GDP side.
When will we see it? They're spending tons of money on the AI data center build out. When will that actually mean jobs?
Well, it may not. So part of the data center component of this story is that AI can reduce some sort of job emphasis. But again, there's a bullish take to this, which is our big take at RBC is that America needs workers, not jobs. And so for a long time, we would hear, what jobs is AI going to steal? That's not our perspective. Our perspective is that AI is going to save us from the labor shortage. Now, it's going to be a bit, I call it sort of an awkward teenage years going forward here. We're going to have some implementation that is a little bit clumsy, too many jobs added, some taken away over that period. But ultimately, we view this as actually being able to produce a more stable equilibrium in the job market, not something that's going to erode this demand for workers without the supply for it.
Where does this kind of relationship leave inflation?
Well, I think we're about to hit the 5-year inflation, 5-year anniversary of inflation above 2%, and no one's talking about that. I think we've all just given in to the idea that inflation will stay around. The Fed effectively doesn't sort of mention that. We talk about the bias towards rate cuts, even though we are 5 years into having inflation above target. And so you're right to call this out, which is that if you have sort of a tight labor market, unemployment rate around 4.3, 4.4, you are going to have a floor under services inflation. It is going to be really hard to see material wage disinflation or deflation in the system. And that's why we say get used to 3-ish inflation. That's here to stay. Now, some folks will say, well, that's not so bad. And it's not. It's not the breaking of the inflation system in America, but it is a sort of more nebulous, maybe even nefarious creep up in prices and a new sort of steady state that's in the high 2s. So folks for a long time said, wouldn't it be so scary if 3% was the new 2%? Well, it sort of crept in like the frog that's being slowly boiled in the pot. That's how I think about the inflation situation in America.
New leadership of the Federal Reserve. I'm sure you've developed thoughts on Kevin Warsh and what kind of leadership he might provide.
Well, yeah, I mean, we have to think about, is there going to be a different sort of bias? But actually, there's always bias at the Federal Reserve. It's just human beings who have perspectives and weight the data from a different perspective. And we kind of think about it the opposite, which is that the data will lead the Federal Reserve. And the challenge going into 2026, what keeps me up night, is not who's Kevin Warsh. It's what does the Federal Reserve do if you see a small creep up in the unemployment rate, but the level is still very low. So, for example, if we go from 4.3% unemployment to 4.5 or 4.6, that's still an extraordinarily tight labor market. But we know this is a Fed who will say we don't like the direction of that going. So I worry about how is this Fed going to communicate an extraordinarily tight labor market and inflation stuck near 3% with a dovish bias.
Didn't we just find out what happens? They cut rates.
Well, that's the revealed bias that's occurring here, but it's going to be increasingly more difficult to do that the longer we keep inflation above target and the more that we see very high growth rates that are in play.
Francis Smart, as always. Great to see you. Thank you. Francis Donald there of RBC on the Federal Reserve and this economic data. More data this morning, 8:30 Eastern Time, US retail sales. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. House Republicans advancing a procedural motion to block a vote on President Donald Trump's tariff agenda. This could potentially delay a vote on the president's most prominent economic policy until at least July. The motion will be voted on by the chamber this week. House Speaker Mike Johnston expecting the rule to be approved. Meanwhile, Kering shares are soaring over in Paris, up nearly 11%. The French luxury goods maker reporting fourth quarter results that beat estimates. Sales at its key Gucci brand falling less than expected in the final months of 2025. Meanwhile, comparable sales fell about 10%, but that still was better than feared. And we are seeing CVS shares sliding in the pre-market down about 3% after the company took a cautious approach to its full-year outlook, holding its 2026 earnings forecast steady. This coming despite the company topping fourth quarter earnings estimates. CVS's Medicare Advantage enrollment declining slightly for the year amid a challenging time for the health insurance industry. That's your Bloomberg Brief. John.
Hey, Yahara, thank you. Appreciate it. Up next on the program, doubling down on debt.
In Q4 alone, the Big Four issued $150 billion of bonds. So, and they're going to spend it. And I think we are still in like the middle innings of the AI CapEx cycle, and I think we are moving much higher.
Up next, we'll catch up with Meghan Robson of BNP Paribas, live from New York City this morning. Good morning. Two days of gains on the S&P 500. We are looking for day 3 Equities up by 0.1% on the S&P, up another 0.12 on the Russell. Under surveillance this morning, doubling down on debt.
In Q4 alone, the Big Four issued $150 billion of bonds. So, and they're going to spend it. And I think we are still in like the middle innings of the AI capex cycle, and I think we're moving much higher. The biggest reason why they're investing is more because they don't want to be disrupted than to make money. As long as they have that disruption risk, it's an existential risk that they're seeing.
So here's the latest this morning. Alphabet tapping the global debt market and seeing $100 billion in orders for its biggest ever dollar bond sale. Meghan Robson of BNP Paribas writing hyperscaler capex consensus expectations for 26 have increased. This reinforces our $250 billion hyperscaler IG borrowing forecast for this year. Meghan joins us now for more. Meghan, good morning. Good to see you.
Good morning. Thanks for
We've got
having
some
me.
time to work through all of these issues. I think the first question a lot of us get asked is why is a cash-rich company like Alphabet with a super strong balance sheet, which can cover all of this themselves, borrowing in the debt market at this scale? Why do they do those things?
It's a great question. So I think there's two reasons. One, we're seeing these capex numbers increase so quickly, and they're really outpacing operating cash flow. So it brings up this sustainability question. If they're planning to continue capex at this pace, they really do need to start issuing debt. And then I think the second piece is tech has been traditionally a very asset-light sector. They're transitioning into building these more hard assets. You look at other sectors like telecom, autos, traditionally more hard asset type of sectors, they have much higher debt stack. So I think it's part of this transition into a business model that's moving into that direction.
So many of these companies, as you know, like Alphabet, can fund this capex through internal operations. It does beg the question how much bigger this cycle can be and how much longer it's going to go on for.
Yeah, it's a great question. Year to date, we've already seen capex for 2026 expectations increase 16%. So that really drives our expectation. The directions can continue to go up in terms of the capex. A lot of that will be funded in the US IG market. For us, our high conviction view is we do think spreads have to continue to go a bit wider for hyperscalers. We think there will be a penalty as the market, we haven't seen it quite yet, but we do think there will be a penalty throughout the year as issuance continues.
A number of investors see a 100-year bond issuance over in the United Kingdom as sort of the warning bell. This is the top. I mean, that's sort of what we've seen in the past. I mean, how do you view something like that in terms of a big company that doesn't necessarily need the cash, but sees really beneficial financing conditions going all in on a century bond?
The century bond is still an outlier, but certainly a sign of just the massive and breadth of demand that we're seeing across the space. I think for us, the risk you really have to think about is, will these companies be able to monetize the investments that they're making here? And we see some early signs that they potentially can. So looking at earnings last week, we saw cloud growth as high as 40% for some companies. That suggests there is, once this supply gets online, there is potential to monetize it. And remember, top line growth for some of these names is 20% revenue. That's still a huge number. So we are starting from a point of high fundamentals or strong fundamentals, but there are some of these concerns that are extremely valid, I think.
We're seeing unbelievable demand. I mean, truly unbelievable demand for a lot of this debt, which raises the question in my mind, how much money is just sitting on the sidelines? How much money is waiting to be poured into this on the part of investment grade bond investors? Or are they selling treasuries? Are they selling some asset to go into some of this debt that they know is going to be issued this year?
We haven't seen signs that there's a selling and a rotation. We do think there's a lot of cash on hand. And to your point about the demand, some of these issues have been 3, 4, 5 times oversubscribed. So the message, I think, is investors are more worried about being left behind, left out of deals, than being having too much exposure at this point. And remember, the hyperscalers in the past have had relatively small debt stacks. So we do think there's not a capacity or overcapacity issue from an investor standpoint of having too much exposure quite yet. There's room to add to these names.
Right, hyperscalers are in a unique position to tap the debt markets. Does it make it harder then for a smaller tech company?
It could. I think that we're still seeing markets are generally open across the board. I think lending conditions are easy. Hyperscalers do have this advantage of scale, and I think across the various software sector that is seen as an advantage, and investors do seem to have a preference for scale in terms of capitalizing on AI.
Do you find it odd that we're seeing pushback in equity and not in debt?
We have seen, so in the IG space, we haven't seen much pushback on debt, but I think that the equity weakness has really spilled over into software of smaller names. If you look at leveraged loans, we've seen some real underperformance there in terms of software risks as a result of the sell-off in software. Software equities down almost 20%. And a lot of the smaller names value their companies and leverage based on loan to value, metrics like that, where they automatically have higher leverage based on some of the weakness we've seen in equities.
Talking about the hyperscalers specifically as well, it's intriguing to me that they come out with these massive capex numbers and equity pushes back, even though equity should be the beneficiary of some of the money being raised to go and build these things, and the debt market's sucking it up. Isn't that a curious dynamic at the moment?
It's a curious dynamic that shows that bond investors either A, have tons of cash and are looking for places to park it, B, are just looking for a return and they're looking at the absolute return and they're not looking for the potential growth factor, or C, are babes in the wood, right? I mean, this is sort of the other argument that some people are saying is that, okay, something's got to give, and it might not be so dramatic. It might just be that slight spread widening or that pushback in specific smaller deals and not necessarily Armageddon.
Based on the moves we've seen, the issuance from Oracle, from Alphabet, there's runway here for this to grow, for this to go on a whole lot longer, which is what Wells Fargo was telling us yesterday. Can we talk about 100-year debt in the corporate credit market? What's that about? Why would someone buy that issue? Can you help us understand that? Now, typically we'd associate that with governments, with universities, the kind of institutions that are around for centuries. Not with tech firms, which is why we keep going back to this 1997 Motorola issue. I've got no idea where Alphabet is next year, 5 years, 10 years. And if we're all worried about the disruption coming from AI, I'm not sure how anyone can have any degree of confidence about where they'll be in the next century. Why does someone in your market want to buy a 100-year corporate debt issue from a tech firm?
Yeah, I think it's definitely a unique tenor, and not only bringing sort of the credit risk that you're talking about, but interest rate market risk, just having that extreme long duration. The 100-year bond was sold in a different currency, so it was sold in sterling. That adds a more specific element to it. But there are certain investors that have asset liability matching, and so it could play into an average duration goal, that having, if they want to extend duration, that is potentially one tool that they can use to do so.
It always blows my mind because this often doesn't work out for sovereigns, never mind companies.
Argentina, Austria. I mean, look at the other examples that really haven't worked out. I think that Marvin Lowe said that the Argentinian 100-year bond didn't make it to the second coupon payment. So tend to be sort of a scattershot result in terms of what you can get. Nonetheless, this really speaks to the dynamic of people having a lot of cash, and it speaks to the liquidity in the system. It still is in the system. So for all the people who are looking for some sort of blowout top that leads to a 40% decline, well, good luck if you have this kind of liquidity and this determination from governments worldwide to keep that liquidity in
You're
markets.
looking for $250 billion in issuance from hyperscalers?
$250 billion is our forecast for this year, and I think we're recommending investors actually overweight the utilities sector versus hyperscalers, both borrowing more to fund this AI capex build-out. Utilities, though, less vulnerable to equities and are also using what's called hybrid structures, so you get a little bit of a pickup in yield. It's more credit-friendly. And we think that's a better way to position.
Is it fair to say also, and I'd love your perspective on this, that management teams at utilities are used to running companies with capex intensity this high?
Exactly. There's less of a transition of the business model for sure. So I think that's a great point as well.
I'm intrigued by this management team sort of dimension when it comes to this massive transition. These are companies that are not used to running their companies this way. I'd love to hear more on that in the coming year.
You have to be a talent manager to becoming an investment manager. And those are two different things.
Massive change.
And ultimately, that's going to be the challenge. And right now, people are just excited about the promise. That will come into play. And it's the reason why a lot of private asset managers have been involved. And I wonder, actually, how much they're getting locked out as some of these public issuances come to the fore.
Alphabet in their earnings talked about these leasing arrangements with third parties. And they said these agreements could, quote, increase liabilities and obligations in the event of non-performance by us, our counterparts, or vendors. This is a new business model that they are embarking with, and that is where the risk is.
Just got an update for you on the debt, sterling-denominated debt from Alphabet, set to raise a record 4.5 billion sterling from that pound bond sale. That headline just crossed on the Bloomberg terminal just moments ago. Meghan, good to see you. Thanks for dropping by. Major numbers. Talking up 250 billion from hyperscalers. Morgan Stanley, by the way, looking for 400 billion this year from some of those names. So these numbers get bigger. Meghan Robson there of BNP Paribas. Coming up on the programme, Eric Johnston of Cantor Fitzgerald, John Lieber of Eurasia Group, Mike Pyle of BlackRock, Matthew Mish of UBS. The second hour of Bloomberg Surveillance just around the corner.
We're kind of still in this low hire, low fire place.
There is a lot of scope potentially for the Fed to cut rates if they had to.
It's pretty clear they're going to do whatever it takes to juice the economy and markets.
It's important that we still get rate cuts this year.
I think there is an upside case for the economy this year.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Two-day rally on the S&P 500, up by 2.5% in just 2 days. This morning, we add just a little bit of weight to it, up 0.1% on the S&P 500. Your scores look like this. On the Nasdaq 100 this morning, just about unchanged. On the Russell, up by 0.15. The focus on the data later this morning, 90 minutes away, U.S. retail sales. The focus right now is on Alphabet. Yesterday, $20 billion bond sale. A record $100 billion of demand. In the UK, a sterling issue, they raised $4.5 billion, and the order book, they draw a record 24 billion sterling of bids. They're issuing a lot of debt, and this market is eating it up.
And they can't get enough. I mean, to think about how much people were clamoring to get in on this. Essentially, what Meghan was just talking about is that people are battling each other to get allocations for the right to buy into this debt at first issue. So if anyone was concerned about a 100-year debt over in the United Kingdom being a sign of the top, it isn't really coming to fruition. It's certainly in markets. At the same time, there will be a limit. We're not reaching it yet, which raises the question, how much further can this build out really go?
4, 5, 6 times oversubscribed. This is what the market wants. It's sucking it up, and these guys are going to provide it for the year ahead. We're talking about numbers of $250 billion of debt coming from the hyperscalers in the next year, according to BNP Paribas. Morgan Stanley going further. They're saying $400 billion. In total, the capex intentions, you're familiar with the numbers right now, $650. Add in the rate cuts, add in the tax refunds. It's why a lot of people are bullish the U.S. economy for the year ahead, and why the president's talking up the prospect of hitting 15% GDP growth over the next 12 months.
So I'm not quite sure we're going to get 15%, but Terry Haines basically said, you know, shoot for the stars, land on the moon, or shoot for the moon, land on the stars, something like that. Set the goal really, really high. But also the president is in midterm election year season. He is going to try to go and talk up the economy, even though everyday people are not feeling it, which is why this is a very difficult story. What does an AI build out mean? Jensen Huang recently was talking about this is a once in a generation infrastructure build out. That means that AI companies, tech companies are coming for your land, and they're increasing your electricity prices. And it is going to be a political issue when maybe these AI companies start putting in some of these codings that end up taking your job.
It could be disruptive for Main Street. And that's the issue the politicians have got. Growth could be good, it could be great. Will it be jobless growth? And that's a figure we'll be talking about tomorrow morning.
Don't panic. Don't panic. It has to do with immigration, so that's the issue. Ultimately, again, it's going to be how much is it the Kevin Hassett world of things, where he's looking at what a lot of economists have talked about, the fact that you do have a lower population, so just naturally you're going to have a lower pace of growth. At the same time, what you're seeing from sentiment surveys, the Consumer Conference Board, even if they might cast some shade on it, there is this feeling that people don't see jobs as plentiful at the fastest pace going back to 2021. So how are we going to bridge that gap? That ultimately is a midterm election question.
If you're just tuning in, welcome to the program. Equity futures this morning up another 1/10% on the S&P 500. Coming up this hour, we'll catch up with Eric Johnston of Cantor Fitzgerald as tech stocks bounce. John Lieber of Eurasia Group as President Trump sounds the economy to sway the midterms, and Matthew Mish of UBS as AI threatens to shake up the credit market. We begin this hour with stocks holding near record highs. Eric Johnston of Cantor Fitzgerald writing, "We think that we have now seen the drawdown that we expected, and it's behind us. We think the equity market will break out soon." Eric joins us now for more. Eric, good morning. Good to see you.
Good morning. Good to see you.
What makes you think the worst is behind us? What gives you that level of confidence?
So we saw a fair amount of capitulation. And it was across asset classes, right? You saw the huge drawdown in silver, saw the drawdown in Bitcoin. We saw software stocks, a pretty big sector within the S&P 500, get hit very hard. And then mega cap, which is very retail owned, also got hit very hard. So you've seen that. You've seen sentiment come down. You can see that in the sentiment indicators. The VIX went to 23, which is also somewhat of a short-term capitulative sign. And then net exposure for institutions also came down. And so that's sort of behind us. And what we have ahead is a very good backdrop for equities from a fundamental perspective.
Where do you think leadership comes from with that in mind?
So I think cyclicals is one area. Cyclicals have mostly performed well, but I think materials and industrials can continue. And then within tech is a much more nuanced sector now. I think software, we have a strong view that software has bottomed, at least in the short term, and that we're going to see a pretty powerful bounce in those names. And then the picks and shovels of this build out. They've done well, so they've had big rallies, whether it's energy, different aspects of industrials, or of course semis and semi equipment. But we think those can continue because of the power of this CapEx build out and some of the CapEx numbers that you've referenced.
We've talked a lot about the debt issuance that's expected and ongoing from a lot of the tech companies. Is this a headwind or a tailwind for the equity side?
I think it's a tailwind. I think down the road, maybe a year or two down the road, it could become maybe a headwind. But for right now, you're unlocking all of this cash into the economy. So you essentially had trapped cash on balance sheets, trapped abilities of these companies to issue debt, and now they're taking advantage of it. And they could do this for years to come and not have any issue with their debt to EBITDA getting anywhere close to out of whack. And so I think it's one story for those four names around how it affects them. I think that's much more of a nuanced view, and we can talk about that. But for the economy and for the rest of the S&P 500, it's extraordinarily bullish. And when you think about the stimulus heading into this economy, it's not just the fiscal stimulus coming from the government. It's this stimulus coming from these hyperscalers. When you think about $650 billion of CapEx from four companies, that probably goes higher than that. And that doesn't include the private companies. It doesn't include Oracle. It doesn't include other parts of tech. So it becomes extraordinarily, powerful for stimulus.
It's a tailwind for energy. It's a tailwind for materials. It's a tailwind for real estate. Is it a tailwind for both big tech and from some of the consumer cyclicals that aren't necessarily hinged to those particular industries, directly tied to this build out?
So I think the consumer has other tailwinds because when you look at the CapEx numbers, some of them there's not a multiplier effect on, and some of it there is. But I think specific to the consumer, you of course have the higher refund checks. Jobs is a challenge, as I think wage growth will be a challenge. But you also have the net worth wealth effect that's affecting about half the country, and that does help consumer spending in a big way because that's where most of the spending is coming from. So I think the consumer sort of indirectly and from other means is going to have some pretty strong tailwinds behind it.
You say in your note fiscal stimulus is powerful, but what besides the rebate checks that individuals are going to get do you expect out of Washington?
So also the tax withholding rate, came down for most people starting January 1st. And then, of course, you have the expensing of CapEx for many smaller companies that we're not talking about and that are not public, that are likely also going to increase their CapEx because they can write it down and depreciate it all in the first year. Now, we are in a midterm election year, and so there's potentially other stimulus to come. Of course, President Trump has talked about the $2,000 checks. Our view is whether it's $2,000 or it's something else, we think something will come. So maybe it's less, maybe it goes to a smaller percent of the population, but you're likely closer to the midterms going to see that type of stimulus coming. And then, of course, you have monetary stimulus.
When it comes to monetary stimulus, you're expecting a dovish Kevin Warsh if he gets through the Senate confirmation hearing?
Yes. So I think he's talked about lower rates for sure. He's also, of course, talked about a smaller balance sheet. I think once he's in the seat, the more dovish Kevin Warsh will be in the seat, and I think he's also going to have a lot of tailwinds around inflation. So if you look at right now, trueflation right now has dropped dramatically over the last 2 months, and that's essentially just a real-time indicator. Every day that comes out looking at prices, it's dropped from 2% to 60 basis points over the last 2 months. And we think that owner's equivalent rent's going to come down. And so I think he'll have the reasons between the inflation numbers and the labor numbers to be able to cut probably 3 times.
3 cuts this year.
3 cuts in 26, yes.
On top of all the tailwinds that we're seeing in growth.
Yes.
That's going to be quite something, isn't it? What kind of level of growth are you expecting?
I mean, I think from a real perspective, we can get somewhere, certainly north of 3%, and I think that we're probably going to see some quarters that are north of 4%. So, I think, and if you look at the equity market, if you think about GDP growth north of 3% with a Fed cutting, that's extraordinarily powerful. If you look back in history, how when markets have had their dramatic sell-offs, they've had it with GDP going negative or being around zero, or you've had an aggressive Fed. We're going to have both of those going in the right direction. And so, there hasn't really been a time where you've had both of those going in the right direction where you've had weak equities.
Everyone who comes on the show this morning, I hear it's going to be a really hot economy. Inflation's not going to run away, but it's going to be around 3%. It screams buy equities, sell the long end of the yield curve, and sell the dollar. I mean, is there anything to push against that type of trade, at least based on that narrative that you just put out there?
So, yes, I would disagree with selling the long end of the curve. I actually think bond yields are going to come in, and it's for a number of reasons. One of the topics that hit the media was around this Treasury and Fed, coming together. And putting that aside, I think the Treasury is clearly focused on getting the long end of the curve down. And there's things that they can do around issuance and moving that closer to the shorter end, which I think that they ultimately will do once the Fed funds rate gets lower. So I think that'll be, very important. And then number two is I think the inflation rate is going to come down, which should help the long end. And then if you look at the deficit in 2025 was down versus 24 as the economy expanded. So that curve, that deficit to GDP ratio is starting to bend lower. And so I think that's also going to be positive for bonds. And so if you have the Fed funds rate go to 3%, I think having a 10-year in that 350 or 375 area, when you have the government wanting that long end down and being able to do things, I think is very realistic.
4:18 this morning on 10s. Eric, good to see you. Thanks for being here. Lots to think about. Thank you, sir. Eric Johnston there of Cantor Fitzgerald. Let's get you an update on news worldwide with your Bloomberg brief. Yahara's back with more. Hey, Yahara.
Hi, John. We're seeing Coca-Cola shares falling 3.6% in the pre-market. The beverage giant posting fourth quarter revenue that missed estimates. The company offered a full-year sales outlook with its high end near Wall Street expectations, bolstered by higher prices and demand for zero sugar drinks. Meanwhile, Barclays reporting earnings last year that beat expectations, helped by the best fourth quarter since 2016. The bank saying it will return at least $20 billion to shareholders through 2028 as it continues to work through a long-term plan to slash costs and improve profitability. And President Donald Trump says his pick for Fed Chair Kevin Warsh will be able to drive the U.S. economy to a 15% growth rate. A lot of pressure there. Trump says Warsh was the runner-up in his last search for a Fed chair, and it was a big mistake to pick Jay Powell, who was pushed by former Treasury Secretary Steven Mnuchin. Warsh's confirmation, though, may be delayed due to a Justice Department probe. That's your Bloomberg brief. John.
Yahara, thank you. Thanks for the update. Up next on the program, selling the Trump economy.
I think we have the greatest economy actually ever in history. Now we have the hottest country anywhere in the world. I guess I have to sell that because we should win in a landslide, and we'll do everything we can to do it.
John Lieber of Eurasia Group joins us next, live from New York City this morning. Good morning. Let's start with stocks. So this morning, bit of a snoozer, up by 0.1% on the S&P, up by 0.2 on the Nasdaq. More data later, you've got all that. In the corporate credit market, the primary market, the supply was seeing anything but a snoozer. So yesterday we had a $20 billion debt issue from Alphabet. They drew about $100 billion in orders, so 5 times oversubscribed. Fantastic, market wants to eat it up. Then this morning, they go global, issue some debt in sterling and the Swissy. These are the headlines based on a sterling issue. So they raised a record, and are set to raise a record $4.5 billion from the pound bond sale. What we understand, based on the demand we're seeing, is sky high, a record $24 billion of bids. And of the maturities, the 100-year, the century bond, actually drawing a lot of demand on this front as well. So look, just another example that the market wants it, and if Alphabet's supplying it is getting eaten up this morning.
And there isn't enough bonds being sold in order to meet that demand. It highlights to me that you can question maybe Google's ability to manage money and manage land and infrastructure and all of these assets, but they are genius at market timing, because right now they are nailing it with respect to how much they're able to sell, at what price they're able to sell based on the U.S. issuance. We haven't gotten, I believe, the pricing for this in terms of what yield these investors are demanding. And in terms of the scope, there is ample room for them to go further.
Absolutely phenomenal. Tomorrow, of course, we'll get some 10-year notes from the U.S. government, so a bit of competition here for them. At the long end, we'll get some 30 years later in the week. 3-year notes, some issuance from the Treasury a little bit later on this afternoon, 1 p.m. Eastern time, I believe, so look out for that. In the bond market so far this morning, yields coming in another 2 or 3 basis points. We're down about 3 or 4 on 30s to 482, on 10s to 417, call it 418, coming into that data a little bit later. Under surveillance this morning, selling the Trump economy.
I think we have the greatest economy actually ever in history. Now we have the hottest country anywhere in the world. That's said by everybody. We have the hottest country in the world. I guess I have to sell that because we should win in a landslide, and we'll do everything we can to do it.
So here's the latest this morning. The president taking ownership of the U.S. economy ahead of midterm elections later this year. An average of polling suggesting about 42% of Americans approve of Trump's performance on the job. Tyler Kendall has more. Hey, Tyler.
Yeah, hey, John, good morning. Well, at this point, the president's right, because according to polling, Republicans are going to need to sell their policies heading into the midterms as the administration tries to refocus the narrative that originally started with President Trump calling affordability a hoax. But now the White House is really going on the offense. We're expecting President Trump to do more domestic travel. He's already ramping up pressure on a potential Fed Chair Kevin Warsh, and we've seen him put out a flurry of new policy proposals, some of them more populist in view. That's why I'm closely watching how Vice President J.D. Vance's campaign schedule evolves in the months ahead, considering he was chosen in part for his more populist ties. We can't forget he was one of the sponsors of a bill that would crack down on credit card swipe fees when he was in the Senate, as just one example. Now, the White House is also touting policies it's already enacted. Tax cuts under the One Big Beautiful Bill, a push to onshore manufacturing. But at this point, Republicans are really playing defense over the issue. Consumer sentiment did unexpectedly improve to a 6-month high, according to the preliminary reading this month from the University of Michigan. But when you dig into the crosstabs, there is still this persistent concern when it comes to the labor market and the impact of inflation. And political polling is showing an even more stark picture. A new poll out from the Pew Research Center I'd point you to shows that the majority of Americans view the economy as negative. 7 in 10 U.S. adults saying that right now their view of the economy is either poor or fair. Now, John, the stakes, of course, as you well know, couldn't be higher. We can't underscore this enough. Democrats only need to net gain 3 seats in order to flip the House. And complicating matters for Republicans is that we are seeing a record number of retirements in the party. In fact, it's actually on track to reach a record level for an election year later this month.
Tyler Kendall, thank you. Thank you for the update. The issue is, for the president, for the White House, is that many of these issues built coming out of the pandemic. The problem they've got, when you sit in the White House, you own it going into the midterms.
And he's owning it, and now he's trying to sell it in the same way that they've sold it in the past, which is, this is really great, this is excellent, and will it translate to how people feel about it?
John Lieber of Eurasia Group has this to say: the primary season will be more unpredictable than usual. The national environment for 2026 looks very positive for Democrats. John joins us now for more. John, welcome. Does the president, do the Republicans have the runway, the time to turn this around?
Probably not. I mean, I think there's a world where there's a booming economy between now and November, and that helps them save some of these marginal seats. But, you know, Americans have to feel it, and they have to be convinced that it's the Trump administration's actions that are driving it. So you want to see lower unemployment, which is very difficult given how low it is already. You want to see the president's poll numbers improving, and he's underwater on all the top issues: the economy, inflation, immigration, and he's got to really change the narrative there. And I think importantly, you need Americans to feel like they can afford what they want. And I think that's the biggest challenge that faced Biden. It's the biggest challenge that faced Trump. You're not going to turn around the price of housing between now and November. Maybe you can make a difference on groceries or some of the other things that people feel are too high priced, energy perhaps. College affordability is not going anywhere. So these fundamental things that make most American voters unhappy just aren't going to turn around. And like you said, John, you own it when you're the president. So if people don't like the direction of the country, they blame you. Trump is personally unpopular and just hasn't proven the ability to expand his appeal really throughout the course of his political career. So it would really surprise me if the Democrats didn't take the House and potentially the Senate, although that's a lot less likely.
So for the remainder of the year, what can we see the White House do to try to turn this around? We saw a beef directive overnight looking at Bangladesh social media. They say that tariff rates are going to be cut. Are we going to see the president actually reverse some of his signature policies?
Yeah, I think tariffs are likely to come down between now and the end of the year. That's probably because of this court case and also because of the cost of living concerns. They're going to continue to push these stimulus checks. They've got a number of other ideas about ways that they can lower the cost of living. But I think a lot of it's just going to be window dressing because the actual levers the White House has to pull aren't that great. Look, the Biden administration looked at all these options, and it's not like there's a big ideological gap between what the Trump team is willing to do and what the Biden team is willing to do. In fact, Trump is embracing policies that even the Biden administration said were too interventionist for the government to think about, capping interest rate fees and stuff like that. So all of these things have been looked at and rejected. If the White House could do something about the cost of living, they would have done it by now. They can goose the economy. They're going to run it hot, and you heard Trump talk about that just now. But I don't think that helps address the fundamental concerns that are a weight for President Trump right now.
John, when it comes to the midterms, how bad do you think it is going to be for Republicans? I know we had that state Senate seat in Texas. That was a plus 17 Trump district. But also over the weekend, another unique election in Louisiana, a House seat. This was another Trump district that a Democrat won. How bad is it going to be for Republicans?
Yeah, the Republicans have a structural issue which is that the coalition that's formed over the coalition that they put together over the last 10 years is a Trump coalition. And that means that a lot of those voters only show up to vote when Trump's at the top of the ticket. 2020 was close. He won in 24. 2016, he was close. He almost won the popular vote. But in the off-cycle elections, they just aren't doing that well. And it's because their voters don't show up. And I probably anticipate that this time around. So you're looking at, if you look at previous wave elections in the U.S., in 2012, the Democrats picked up about 60 seats. In 2018, the Republicans picked up about 60 seats. In 2018, the Democrats picked up about 40. And I think because of redistricting and gerrymandering and the way they're able to draw districts, even a wave election this cycle where, let's say, the Democrats are ahead by 3 to 5 points in the national popular vote, which would be huge, I think there's a kind of a ceiling as to how far they can go because these districts have drawn to be so friendly to Republican incumbents. So I would be looking for a 20 to 25 seat shift. Anything less than that, if it's in the 10 to 15 range, is probably a good night for the Republicans. Anything more than that would be a real, I think, massive wave for the Democrats.
House Republicans who are up for re-election, how much are they closely aligning themselves with President Trump and his agenda right now versus trying to distance themselves?
I think you align yourself with the president through the primary, and you want to look like you're a problem-solving guy or woman that gets things done. And aligning yourself with the president in the general can be helpful with that. Again, a lot of these districts are very, very safe. So, most members of Congress are going to say, "Hey, I'm a Trump Republican. I want to get this done for President Trump." There will be a few who are in these more marginal seats, people like Mike Lawler in New York, Susan Collins in Maine, who's not running, but, they've got these people who are in these more moderate seats who are going to be looking to make distance from the president, but it's not going to be, I don't expect a jailbreak for Republicans between now and November.
Hey, John, it's good to see you. John Lieber of Eurasia Group. We'll catch up again soon. For all the talk of fantastic GDP growth in America for the year ahead, go to the ECFC screen right now. Economists on Wall Street are not buying into that at the moment. The median's 2.4%. Now, 2.4 is okay. It's a decent number, but it's not 3. It's not 4.
Yeah, ultimately, where is this investment going? I mean, Torsten Slok just put out a note saying that there's going to be no impact of AI except for the big tech companies in terms of making their earnings better. So that's the sense that you're getting from Wall Street.
Torsten makes you think. That's why I love the Torsten notes. It makes you think. The prospect of a conversation about rate hikes by year end. We'll see. Mike Pyle of BlackRock up next. Two-day winning streak on the S&P 500, the biggest two-day gain going back to November, higher by around 2.5% this morning, up another 0.2%. Likewise on the Nasdaq, likewise on the Russell. In the bond market, anticipating the retail sales data 60 minutes away, with yields down about a basis point at the front end of the curve and down 2 or 3 at the long end. 10's down to 417.63. 30s down to 482. This is going into supply, both 10s and 30s over the next few days. And some interesting comments from Kevin Hassett, the NEC director, in the last 24 hours.
It is fascinating that Kevin Hassett's potential nod, maybe if it was that, to a weaker than expected labor market, jobs market number, is triumphing over all of the supply concerns, over the potential for China to stop selling, as the Bloomberg broke yesterday, and as well as what's going on at the Bank of Japan and potentially a Japan fiscal policy. We're talking about $42 billion of 10-year notes coming tomorrow. We're talking about $25 billion of 30-year bonds from the United States government that will be a competition potentially with big tech companies that are also issuing massive amounts of bonds. So it really highlights how there is ample ability to soak up this debt.
No pushback in corporate credit or in the sovereign debt market at the moment. We'll have more on that Alphabet issue in just a moment. As we count you down to the opening bell, 2 hours away with your morning movers. Here's Yahara with more. Hey, Yahara.
Hi, John. TSMC is riding the AI money wave. Shares are up nearly 3% in the pre-market after revenue in January surged 37% as the hyperscalers line up to spend $650 billion this year alone in AI capex. And demand is so strong at TSMC that it's also planning to spend big. It's earmarking $56 billion in capex this year alone, about 25% more than last year. Meanwhile, moving on to Spotify, those shares are soaring up 11% now in the pre-market after it reported record user growth. It added 38 million users, far surpassing analyst estimates and marking its biggest jump ever. They say that the strong results were fueled by their Wrapped campaign, which essentially gives you a roundup of the artists and songs that you listen to and allows you to share it on social media. So the viral campaign helping to fuel growth. And we end on Coca-Cola. Those earnings out just moments ago. Shares of the beverage giants are falling 3%. It did post annual sales that were in line with estimates, but it's slower than expected. Fourth quarter revenue is what's weighing on the stock. On top of that, shares were up 12% this year heading into the print, so the bar was high and it did not meet it. John?
Yahara, thank you. Thanks for the update. On our radar this morning, the president claiming his pick to lead the Federal Reserve, Kevin Warsh, can drive the U.S. to incredible economic growth.
We should be at 15%. I'll tell you, if our new head of the Fed, who I think is going to be great, and he's a really high quality person, but if he does the job that he's capable, we can grow at 15%. I think more than that.
The president also saying it was a big mistake to pick Fed Chair Jay Pyle, who was pushed by the former Treasury Secretary Steven Mnuchin. Elsewhere, President Trump threatening to block the opening of a bridge connecting Michigan and Ontario until Canada, quote, treats the U.S. with the fairness and respect that we deserve. His comments coming as the two nations prepare to renegotiate USMCA. And finally, Alphabet selling at least $9.4 billion in sterling and Swiss franc denominated bonds, including an ultra-rare 100-year note. The debt sale coming as the tech giant plans to spend as much as $185 billion this year on its AI build-out.
We're getting more details about the 100-year bond sale, which is really notable considering how rare this actually is. Alphabet received more than 7 times the orders for this sale of 100-year debt in the United Kingdom, which just highlights that, yes, you have a lot of naysayers saying, why would anyone buy into a story that is based on the most modern and current technology 100 years out, when potentially this will look like the horse and buggy? Well, whoever wants it, they want it in bulk, and that's what we seem to be seeing in markets.
We said at the start of the programme that sterling is a natural denomination for an issue this long. There's that kind of demand out there in the UK in the sterling debt market. This is not a natural issuer for debt this long. Usually it's a sovereign, a university, an institution that's been around for centuries already. So it's curious that we're seeing this for the first time since 1997, and obvious comparisons will be made to that period.
Well, Motorola was the last one to do it in 1997 in terms of a tech company. And people are saying, is this the peak? I don't know if you can say this is the peak, and I will just say, objectively, taking a look at how much demand there is, the fact that we've been saying that this could be the peak and that people are pushing back and saying okay, I'm going fists in, let's go. Just highlights how much people are rejecting that narrative.
Well, let's stick with tech. TSMC also reporting a record surge in revenue, signaling strong demand for data center chips. Mike Pyle of BlackRock weighing in on the AI trade, writing the following. Recent moves suggest this is not hype or bubble behavior, but markets adjusting to disruptive technology. There has never been a more important time for active investing. Mike joins us now for more. Mike, good morning.
Great to be with you.
Before we build on that, I'd love your reaction to the issue that's come from Alphabet and more broadly the hyperscalers and the amount of debt they will be issuing and the amount of demand there is for it on the other side.
Yeah, I mean, I might just make 2 points. I mean, one, to your point, Lisa, there continues to be ample demand for debt out there of all different varieties. I mean, one thing I was looking at to go to the story you highlighted about the news we heard from China overnight, looking at just the market for U.S. Treasuries, if you roll back the clock 15 years ago, the buyer base was 50-50 between foreign and domestic. Today, it's 75-25, 70-30. It just highlights that, this has been a long-running trend. There's been a huge change in the composition, but there's continued to be really strong demand. I think similarly, when you look at something like the Alphabet issuance, I mean, what we've seen in markets recently is, a change in the composition of the AI thesis, but if anything, that thesis deepening. So I think both of those things, that long-running demand for high-quality paper, combined with, if anything, the deepening of conviction in AI in markets, even as that's changed, highlights to me, this is something we're going to see more of.
We've had about 10 years of price action in the space of 1 month and 10 days so far this year. You came into the new year pro-risk. Is your conviction higher or lower now?
I think that the interesting thing in the market this year is it just highlights that every choice is an active choice. That, one of the things we were saying coming into the year is, even just to take basic index exposures, you're making an active choice. If you take something like the market cap S&P, you're making a pretty high conviction bet in the ongoing outperformance of the mega caps and that expression of the AI theme. If you take something like the S&P equal weight, you're taking a view that's not going to play out. And what we've seen this year is that S&P equal weight is where the overperformance has been, exactly as that AI thesis has changed shape and reflected a different aspect than what we saw last year.
Well, it's fair to say, what is your framework as you are as an active investor? And as we're talking about this CapEx boom, especially as we're going to get all this economic data, there's a real question, how much will it get to the underlying economy to help fuel that broadening out? Torsten Slok has a note that's pretty provocative out this morning saying that AI only benefits tech companies when it comes to increasing their profitability. Do you agree with that? Do you think that ultimately that is going to be kind of a bifurcated story that doesn't hit the underlying economy?
I guess my view there is that's not exactly what we've seen getting reflected in markets year to date. If you look at places where we've outperformed, and you guys have talked about it here, it's been the physical over the digital. I mean, we've seen places like commodities and commodity producers. We've seen spaces like energy. We've seen places like industrials and cyclicals more broadly have a significant run of outperformance. That's been reflected in the U.S. equity market. It's also been reflected in global equity markets and where we've seen outperformance like in emerging markets, like in Asia, ex-Japan, like in Japan itself. I guess my view is, when we look at markets year to date, it's a little bit the other side of that thesis from Torsten.
Do you have to treat the United States, and I'm saying this delicately, more like an emerging market, as you hear the president say things like he wants to see the growth rate above 15%, which usually is more of a developing market trend than a developed market one?
I think what I would highlight is when you look at the ongoing quality of the U.S. corporate sector, it's very clear there's no market quite like the United States anywhere in the world. And yes, are there going to be moments of policy uncertainty, moments of geopolitical uncertainty? Sure, that's what we've come to expect over the last period of time. But also, I think markets have shown that they can absorb that, they can digest that, and they can look through to ultimately the economic fundamentals and the corporate and technology
Mike's not taking that bait, Bramo.
Well, that was really
good try. It's not taking that bait.
Very diplomatic.
Wow.
That's not a headline.
Shocking, you bring a diplomat on the air, and what you get is diplomacy.
Well, oh my goodness.
BlackRock, third world country. Yeah. That is not the headline. No.
I mean, I was trying.
Not the headline.
Come on.
They won this
and then
morning.
I saw that complete pun. We think that the United States is a deep liquid market. And you have to look at all these things.
That's just not going to work for Larry Fink or Mike Pyle. But Mike, you worked on Pennsylvania Avenue and you work on Wall Street. We've been having this discussion all day about what AI actually could mean for the everyday consumer. High electricity prices, potentially job loss. What do you think is going to be the policy response? I mean, the Anthropic CEO is meeting with Elizabeth Warren today. There is going to be a much more specific focus in Washington on what all of this means for everyday Americans.
I guess I'd say when we look at the AI build-out, there are a range of constraints that are going to have to be navigated. There are energy constraints, there are financing constraints, there are political and policy constraints. I think right now, and my colleague Wei Li was saying this the other day, the binding constraint is energy. And there's a lot of work to do, including, frankly, in the policy and regulatory space around permitting, to relax that bottleneck and to create more energy supply like what we're seeing in other parts of the world. I do think as we roll the clock forward, there's going to be a lot of focus on navigating the emergence of political constraints as well. Clearly, the AI build-out is a growing political issue, and I think it's going to take a lot of focus from policymakers more broadly to clear the space to create positive sum build-out.
You mentioned Anthropic. I'm fascinated by Anthropic, the headlines and the marketing around that name. And we were exploring this at the end of last week, just whether they are really punching above their weight in ways that maybe their market position doesn't really justify.
Yeah.
And how many of the headlines we're seeing around this company are really just about the pre-IPO roadshow. And I said, last week I just felt like the roadshow had started for Anthropic. These are the headlines they want us to be talking about. Highly disruptive. It's going to lead to all of these job cuts because the technology is that powerful.
Yeah, and then you start digging in, and that's what people have been doing over the past couple of days. What are the capacity? What are the capabilities potentially? You're right, and that's the reason why you saw software stocks bounce. There is this question, though, hanging over the entirety of the sector that we don't understand what is going to get disrupted and in what time frame. A lot of that is TBD. Anthropic certainly does have the upper hand on that, and congratulations for some great ads during the Super Bowl.
They did have great ads during the Super Bowl, and OpenAI had something to say about that. You can go look at a very long tweet from Sam Altman. But when it comes to this idea of you have to justify the CapEx spend, and that is what Ben Affleck said a lot of these companies are doing when he was asked about Joe Rogan and how AI is changing Hollywood. He's like, all of these companies have to justify all this spending they have, which is why they're coming out with these huge pronouncements.
I have to say, he sounded like a fantastic Southside strategist.
I know. I'm trying to book him.
Just in case he wants to give up the act. I don't know. Mike, it's good to see you. Thank you, sir.
Good to be here.
Mike Pyle of BlackRock, one of the very best breaking down this market. Let's give you an update on stories worldwide with your Bloomberg Brief. Here's Yahara with more. Hey, Yahara.
Hi, John. More details emerging on Alphabet's turn to the global debt market. The Google parent is selling around $9.5 billion worth of bonds denominated in pound sterling and Swiss francs. The sterling offering drawing high demand with a record $32.8 billion worth of bids. It follows yesterday's $20 billion 7-part dollar debt sale. Meanwhile, Standard Chartered CFO Diego DeGiorgio resigning to take a role with Apollo. DeGiorgio joined the bank in 2023 and was seen as one of the front runners to eventually replace longtime CEO Bill Winters. He will move to Apollo as a partner and head of Europe, the Middle East, and Africa. And President Donald Trump is scheduled to travel to China in April, the White House saying there are no exact dates yet for his visit with Chinese leader Xi Jinping. That's after Politico reported Trump would head to Beijing to meet Xi in the first week of April. The report says the two leaders could potentially meet 4 times this year as their trade truce holds. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for the update. Up next on the program, Big Tech's debt binge.
We're seeing these CapEx numbers increase so quickly, and they're really outpacing operating cash flow. So it brings up this sustainability question. If they're planning to continue CapEx at this pace, they really do need to start issuing debt.
Up next, we'll catch up with Matthew Mish of UBS, live from New York City. You're watching Bloomberg Surveillance. Just turning slightly lower in the last 15 minutes or so. No drama, down by not even 1/10% on the S&P 500, following a two-day rally of 2.5%, a two-day tech-heavy rally in yesterday's session. Particularly, the financials started to struggle just a little bit. We snapped a five-day winning run of regional banks grinding higher. Massive run for some of those names. Elsewhere on the Nasdaq, just about positive by not even 1/10% and unchanged on the Russell. The action is very much elsewhere in fixed income. Under surveillance this morning, big tech's debt binge.
We're seeing these CapEx numbers increase so quickly, and they're really outpacing operating cash flow. So it brings up the sustainability question. If they're planning to continue CapEx at this pace, they really do need to start issuing debt. Year to date, we've already seen CapEx for 2026 expectations increase 16%. So that really drives our expectation. The directions can continue to go up in terms of the CapEx.
So here's the latest this morning. Alphabet tapping the global debt market and seeing record demand. The offerings including a rare 100-year bond denominated in pound sterling. Matthew Mish of UBS writing, we see IG tech issuance growing significantly, fueled by hyperscalers increasing supply in EU markets. Matthew joins us now for more. Matthew, welcome to the programme. What a morning to have this conversation with you, sir. What kind of numbers are you setting clients up for in the year ahead? How big could this issuance be?
Yeah, I mean, we have been moving our estimates gradually higher. I think last year we had over 200 billion of IG supply. More broadly in global markets, we had, call it 600-700 billion. And this year we've been moving IG higher. We're now kind of north of 300 billion. And we think more broadly, global tech issuance led by AI is really going to be hitting over $1 trillion this year, with an expectation again of a run rate of, call it almost growing 100% or doubling every 2 years. So it really is monumental. And it raises the question of, if the market can digest all of that supply. But more importantly, the conversation we've been having with clients over the last week is really, if AI continues to develop at the rate that it does and penetrate in the enterprise space, how disruptive is it going to be for companies and a lot of the credit markets where, a lot of these securities were underwritten really when AI was just coming into fore, or even before AI. So it really raises the question of disruption and then ultimately the outlook for credit risk.
Well, let's start with demand, Matt, and then we can get to the disruption. Who's the natural buyer of all of this when you get a 100-year issue in a place like the UK, sterling-denominated debt? When you get issuance of this size and we see it massively oversubscribed, where's the demand coming from?
I mean, a lot of it is institutional investors, it's pensions, it's life insurance companies. That demand for long duration assets has always been existent in the market. And to be honest, outside of a few areas, the U.S. really as an example in the U.S. credit market, it's hard to get long duration in the portfolio or on the book. And so I think a lot of this is really coming from the core institutional client base. And our conversations, certainly with those investors, would indicate that there is a dearth of supply at the long end of the curve across fixed income. And they want to see more, particularly if it is in the corporate market where they get a little bit more spread and can hit yield bogeys that they're looking, again, in many cases to either asset liability manage or essentially just lock in higher yields for a long period of time.
Matt, let's get to the disruption side of the story that you've been referencing. You've talked about how this is going to potentially create a lot of potholes in the credit markets. Can you give a sense of the scope of how much disruption you think that would be and put some numbers to that?
Yeah, it's a great question. Look, we've run a scenario where you have rapid and severe disruption. So you could think of the market as expecting disruption really just a few weeks ago. I would say more of a 27, 28, 2029 issue. The market is pulling that forward, and the key question we're getting is the timing. So in the scenario that I'm outlining, we essentially assume the timing happens by the end of the year, and it's very severe disruption. So the developments on the AI side related to some of the new models that have been released, Claude or Gemini, the expectation in this scenario is that you continue to elevate and improve or accelerate the model development at a nonlinear rate. If that's the case, we generally think that you have exposures that are largest in loan markets. So private credit and leveraged loans in particular, we think have about 30% of the portfolio in private credit and about 15 to 20% in leveraged loans that is essentially high disruption in terms of the categorization that we give. From a default rate perspective, if that scenario materializes, and it is a tail risk for us at this point, we think default rates could go up materially. And so for leveraged loans, we think they go up 6-7%. For private credit, you could see essentially about an 8 or a 9% increase. But the key question really that we and everyone are asking is, what is the timing as it becomes more and more evident that disruption will happen? Again, the timing is really the key question that everyone is asking us.
Matt, do you have a sense of what kind of expectation there is internally among private credit managers in terms of defaults? In other words, how protected they are against some of these tail risks in the case of severe disruption?
Yeah, I think, look, the asset class has had a very strong performance over the last decade. It's been a great place to invest. And managers, to answer your question, don't expect that to last forever. So I think in a world where you have default rates, there's a number of different metrics, obviously, for where private credit defaults are right now. We generally say 3 to 5 or about 4%. The market is expecting, and managers are expecting, an increase of a few hundred basis points. So 200 to 300 basis points is still kind of our baseline. I would say that that's manageable, again, after a decade of very good returns with very low losses. It really is the case where if you get a significant spike in default rates, and in general, we would suggest that number goes from 4% to something like 10 or 15%, so low double digits, that I think you'll see more problems in the system. And that's pretty consistent, Lisa, with what we see traditionally, which is, average default rates for high yield or leveraged loans about 4%. Markets can work and participants can work through that type of a default outcome. It really is when you get a spike to kind of that 8, 10, or even 10 to 15% level that you start to see more spillover, and you start to see somewhat of a vicious cycle in terms of contagion to other parts of the market, the credit market, and also into the financial sector.
So, Matt, that's the piece of it that I'm interested in, the prospect of contagion. I'm going to try and find some positive spin, and you can maybe push back if you want, by all means. But, Matt, if the disruption's that great on one side, is the margin improvement elsewhere going to be fantastic to offset some of this? And how bifurcated could the market become?
Yeah, I think dispersion or bifurcation is a great term. That's still how we're thinking about it in the base case. Because the reality is, if there are winners from disruption, the new challengers in the marketplace that are taking share, in theory, it depends on the asset that you own. So if you own equity, if you own private equity, you're going to have parts of the portfolio that should do quite well in terms of share price performance. And then you may have parts of the portfolio that are, quote unquote, losers or disadvantaged by AI. But on balance, that's a risk reward that isn't necessarily, to your point, negative. The problem in the loan market is just the structure of the loans are such that if you have a winner or AI, let's say either the firm is a leader or a challenger that wins in AI or is able to use that technology to improve operating fundamentals, most of those loans are either traded or marked currently at par. And if they trade above par or they appreciate, normally they get refinanced. So you lose the upside in a credit portfolio, but you're exposed to the downside.
Matt Smart. Thank you, sir. One of the best conversations we've had in the last month, for sure. Matthew Mish there of UBS on the credit market. Just a clinic, I think it's fair to say.
The reason why people want the upside risk of equities and not necessarily the downside risk of some of the riskier credit.
Up next on the programme, we'll catch up with Michael Kantrowitz of Piper Sandler, Craig Daco of EY-Parthenon, Kristina Campmany of Invesco, and a whole lot more. The third hour of Bloomberg Surveillance, up next.
We're trying to diversify the tech trade.
It's all part of that rotation story that we're talking about.
We need almost those big tech companies to be performing well and delivering.
The opportunity set for small caps has become a bit more narrow.
The net of everything is that it seems to be more about positioning, valuation, and sentiment recalibration, not a deeper growth scare.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Equity futures rolling over. We're down by 0.1% following 2 days of gains on the S&P 500, down by 0.1 also on the Nasdaq 100. Later on this morning, it's about 30 minutes away, the first data point in a long string of data points for the week ahead. Retail sales at 8:30 Eastern Time before payrolls tomorrow.
Is this a boom economy? Ultimately, that is what this entire market is leveraged to, that this will be an economy that is being run hot without the inflation and with a huge capex boom. Do we get the ratification of that in the numbers, leading with retail sales, which have been completely skewed by the upper end of the K? So are we going to see a continuation of that, or are we going to see a broadening out in terms of the types of sales that really are driving this?
I saw a note out of Bank of America a little bit earlier on this morning from Adichie Bave, who basically said, you see any weakness in the spending numbers, fade it, because they're bullish growth and things are going to pick up in the year ahead. And the president hopes they're right.
Oh, he does. And he's out what he says he has to sell the economy right now. And that's why he's talking about 15% GDP, maybe more. In terms of that's what Kevin Warsh could deliver. Kevin Warsh has a growing to-do list. At the same time, you have Citi coming out with a note saying we see more risk to markets if spending is weaker than expected. It's going to be a real testament. We get a lot of this data this week, retail sales, jobs, and CPI. What is going on the underlying economy? Because we know where the growth is coming from, and it's coming from these hyperscalers.
They're spending a lot of money, issuing a lot of debt, and guess what? This market is supporting that build-out big time. Alphabet with a big bond issue in the last 24 hours. Yesterday in dollars, today in Swissy and in sterling, and the market's sucking it all up.
7 times subscribed, oversubscribed when you see the 100-year tranche over in the UK. They were able to sell plenty. You saw the same kind of trend in the United States, where they were going to sell $15 billion worth of bonds. It was $20 billion, and it was 5 times oversubscribed. So it raises the question of how much further this can go. Clearly, there is plenty of cash to be put to work. People are absorbing it. People are saying, go, go, go. We want to see this build-out plan. Is there a constraint for smaller companies? Is this going to only fuel something that's going to come to roost later? I know I sound like a worrywart, but we can talk about that later.
Well, you should be worried because there obviously are risks, especially Jonathan and you point out all the time that these are companies that are tech companies, and now all of a sudden they're going to be retail companies or energy companies. Meghan talked about $250 billion this year in terms of borrowing. Jonathan, you brought up Morgan Stanley. $400 billion. And I saw Moody's with the stat that AI-related infrastructure spending over the course of 5 years will be $3 trillion. It's an insane amount of money that's almost hard to really understand and grapple with.
As things stand, this bond market is not pushing back. Equities rolling over just a touch. We're down by 0.1%. Coming up, we'll catch up with Michael Kantrowitz of Piper Sandler, with stocks hovering around all-time highs. Greg Daco of EY breaking down the latest retail sales data, and Kristina Campmany of Invesco as US dollar concerns continue to grow. We begin this hour with stocks holding steady, aiming for a third consecutive day of gains. Michael Kantrowitz of Piper Sandler writing, we're in the midst of the first fundamental rotation in markets since 21, and we continue to prefer value cyclicals as the backdrop broadens out. Michael joins us now for more. Michael, welcome to the program. As you've noticed, we've had years of this market economic bifurcation. Are we starting to see some of that unwind?
Yeah, absolutely. And unwind, I think, is the right way to think about it. In a sense, we're beginning to go through the opposite of what we saw start to take place in 2023, where AI was booming, and it was the only thing where earnings were picking up at the time, where the rest of the economy was really starting to suffer from the price shock of 2022 and the resultant increase in interest rates from the Fed and on long bonds and the mortgage rate. So the good news is that unemployment has gone up. Yes, and that's good news because it's helped to bring down interest rates, inflation, and energy prices over the last 2 years, which now sets us up for a broadening macro backdrop for the first time since late 2020.
So, Michael, if that's the trade, let's talk about how to play it. So traditionally at the index level, as you know, when price appreciation is elsewhere, and Liz Ann Saunders of Schwab's done a great job on this, price contribution is still coming from the same place. The heavy lifting is done by tech, given the weighting on the S&P 500. With that in mind, how do you want to play the story this year?
Yeah, it's really outside, certainly the Mag 7 and the largest tech growth stocks that have done really well. And it's not to take away from them necessarily, but we're certainly seeing more questions about future profitability, future debt raising to fuel a lot of this CapEx, and have free cash flows obviously grinding to a halt at a time where we're seeing parts of the economy essentially wake up for the first time in about 4 years. So we've recommended for investors to move down and out and that's down in market capitalization and out of large growth stocks and into cyclicals. And that means sectors like financials, industrials, energy, and some consumer areas, and out as in outside of the U.S. Because there's much more cyclical exposure in global markets outside of the S&P 500.
Michael, how broad is the broadening out when it comes to the economic benefits that we're seeing from the artificial intelligence boom that we're seeing at the big tech names? I mean, this is sort of the ultimate question, right? How much of this broadening out is because of AI, and how much is it in spite of AI because of some of the incentives that have been given to really engage in capital expenditures?
I would say it's the bulk of the broadening out is really from old school classic macroeconomics in what I mentioned earlier, that interest rates have been coming down and there's a lot of fiscal stimulus this year. Some of it, I would say the broadening out has come from the AI area or the AI trade. In one sense, we've seen multiple compression in the NASDAQ over the last few months as investors seek to diversify away from, again, what was the only area growing earnings. And then, yes, the build out of AI is moving clearly just beyond the hyperscalers. And the benefits of AI, while not strongly broad-based, are clearly starting to show up in company comments and company fundamentals. But that's got a long way to go. But this story, to me, is really about cyclical stimulus coming from monetary and fiscal policy.
You have a phrase in some of your notes that I think is really interesting. You said that our outlook for the economy and markets can be summarized in one simple phrase: stocks will have to earn their returns. What does earning their returns look like based on the fact that we've seen some results that have been really positive, with positive projections that beat expectations, and then the stocks have been punished for expectations beyond their control?
Yeah, well, a lot of that's taken place, again, in some of the larger cap AI related names. What we mean by that is the last 3 years, there's been AI earnings, which have driven large cap growth stocks up phenomenally. Plus, they've had the benefit of multiple expansion that's taken place across the equity market from interest rates and inflation coming down since 2023. Now, if you're a small cap investor, you've only really seen multiple expansion. You've not seen better earnings data in 3 years. Now, as we start to see the macroeconomy begin to heal and positive data points in manufacturing, transportation, housing activity, that's corresponding with some better earnings breadth. So while the market's been led by both AI earnings and broad PE expansion in the last 3 years, we think the story going forward is really all about incremental earnings. No more PE expansion from here, but the incremental earnings are going to show up in areas of the economy that, again, have been kind of left behind for many years now.
When it comes to the broadening out, is it based on the rate cuts we've already had, or you're expecting more from a new Federal Reserve under Kevin Warsh?
No, it's based on what's already taking place. I would argue we don't need more rate cuts at this point. A year ago, 2 years ago, and 3 years ago, you did, because there was no improvement going on or taking place or set to take place in the macro data or in the breadth of earnings data. Now we've seen earnings broaden out for the last quarter and a half. And all the stimulus that's taken place over the last 2 years, that's also being combined with the fiscal stimulus this year, is already in place to continue evolving this soft landing we're seeing in the economy. So no, we don't think we need to see more rate cuts to get to where our preferences are within the market.
You don't think we need it, but do you think we're going to get it?
We may get another cut or two. However, I would say we're not going to see a cut because we're seeing a spike in unemployment. We may actually see some better inflation data in the next several months, which may allow another rate cut to take place. Our view on employment is that we're going to continue to see some sluggishness, but we're not concerned we're going to see a spike in the unemployment rate. So kind of more of the same with respect to employment. And our view on interest rates is that they're going to stay somewhat range bound at this lower level, especially on the long end. And that's good news. Again, I would argue it's good news that we have softer employment in the context of it helps to provide relief for parts of the rate-sensitive economy like housing and manufacturing, which are already starting to show up.
Michael, it's good to see you. Interesting thoughts. Michael Kantrowitz there of Piper Sandler talking about rates. Yields lower across the curve today. The front end of the curve down 1, 2s at 347, 10s at the moment down 3 at 417. Later on this morning, about 20 minutes away, we'll talk about US retail sales. The story of the moment, though, is the amount of issuance we're seeing from the hyperscalers, including Alphabet, in the last 24 hours. The capex intentions are sky high, $650 billion across 4 names, and it might get bigger. This from Savita Subramaniam over at Bank of America. Hyperscalers 25 capex revised up by a whopping 30% since reporting 24 results at this time last year, suggesting upside risk for AI capex from here. And we've heard that from a few people in the last few days.
And that's been the path of travel. I mean, if you think about it, even Alphabet, $185 billion for 2026 in terms of capex plans. That's double what we saw last year. I mean, the increase that we've seen so far has been exponential. How much can they continue that? I mean, if you think about a once-in-a-generation build-out, is this going to be over 2 years? Is it over 3 years? Or is it exponential for 6 years? Because at a certain point, people are going to put up the stop sign and say, I've got enough 100-year debt.
Existential risk. That's what they think they're facing, right? Which is why they've been so aggressive. And they've got the balance sheet to do it, and the debt market's come along for the ride if they wanted to.
What's the ultimate goal, though? I mean, I keep going back to this. Is it just absolute intelligence that's going to disrupt humanity? Is it, the idea of, just simply disrupting some of these basic industries? And I think that's an important question, because none of these big tech founders can answer that. What is the the application for all of this technology that's going to lead to real-world gains? We have to eventually see that in order to justify some of these really ambitious plans.
You want to see the proof in the pudding, but the issue is right now, when it comes to all these tech companies, they just don't want to be left behind. And it is a race right now. So if you see Meta doubling down and spending X, Alphabet comes out and says, well, actually, we're going to top you. And that is what the race is right now, until potentially they start hitting some of these risks.
Which generates a lot of questions. But here's my one. What does that mean for OpenAI and a big capital raise we're about to see in the next year? Because these are the guys with the balance sheets to do it. These are the guys already putting up the revenue numbers. Never mind the promise of revenue in the future. They can cover it with internal operations. That's done. They're fine. Alphabet's got the means to do this. And if they want to get really aggressive, they can make it even more uncomfortable for the likes of OpenAI.
The key question embedded in that, I think it's a really good question, is how intertwined are their business models with OpenAI? How much are they dependent on some of the ChatGPT and related models that OpenAI has developed in order to continue to apply some of the technology? Or are they developing their own internal competitors with the likes of Sam Altman's company? How much are we going to see that also from Anthropic? These are some of the reasons. I mean, NVIDIA, why are they investing so much in OpenAI? They need to have some diversification as Google creates its own chip to try to compete with NVIDIA. So this is going to be a very complicated and competitive landscape.
There's a big 10 months ahead of us, that's for sure. Equity futures rolling over just a touch. We're down by more than 0.1% with an update on stories worldwide this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. We're seeing Spotify shares rising more than 8% in the pre-market after reporting a record-setting number for monthly active users added in the fourth quarter. The company crediting its success to its end-of-year Wrapped campaign and the launch of an enhanced free tier around the world as contributing to the growth. Meanwhile, President Donald Trump says his pick for Fed Chair Kevin Warsh will be able to drive the U.S. economy to a 15% growth rate. Trump says Warsh was the runner-up in his last search for a Fed chair, and it was a big mistake to pick Jay Powell, who was pushed by former Treasury Secretary Steven Mnuchin. Warsh's confirmation, though, may be delayed due to a Justice Department probe. And billionaire Meta founder Mark Zuckerberg is planning to buy a property in the Miami area. Sources telling us here at Bloomberg that Zuckerberg and his wife Priscilla Chan are looking at purchasing a property on Indian Creek, a man-made island known as Billionaire's Bunker. Residents of the ultra-secure enclave include Jared Kushner and Ivanka Trump, Jeff Bezos, Carl Icahn, and Tom Brady. Funny, he already knows who his neighbors are. That's your Bloomberg brief. John?
Lucky him. Yahara, thanks for the update. Thank you very much.
What a quinky dink. Who would have thought?
You know?
I mean...
These guys have got property everywhere.
Yeah.
How much signal can you take from that?
How about, honestly.
It's the bunkers in New Zealand that concern me.
Yeah, well,
as long as they're the ones that kind of like freak me out.
Well, as long as they don't have a go bag and a spaceship in their backyard to go to space.
That's what concerns me.
Yeah,
they're ready to go.
Yeah, then
what are they ready to run away from?
Exactly. If they have their own island with oxygen supplies, let's stock it there.
Cause for concern. Up next on the programme, the morning calls, plus Alphabet becoming the latest tech giant borrowing big in the race to fuel AI spending. That conversation up next, live from New York City this morning. Good morning.
This is not an economy that requires a significant amount of job growth behind it. We're used to an environment where growth is a rising tide that lifts all boats. Not so in this particular environment. Despite these high growth numbers that are likely to come through this quarter in the next few months, you are still going to see the issues that have weighed on Americans over the past few years persist.
That was Francis Donald of RBC. You could have a scenario once again where GDP is close to 3 and payroll growth is muted for a whole bunch of reasons. That could be the story we see again this morning with retail sales at 8:30 Eastern time, and then again tomorrow morning with payrolls on deck, and we're looking for a number around 70k. Going into the opening bell, 1 hour and 12 minutes away. Equity futures on the S&P pulling back by 0.1%. Likewise on the Nasdaq 100. That's the price action. Here are your morning calls. First up, Barclays raising its price target on FedEx to 450, citing its rising business-to-business market share. Your second call from Piper Sandler raising its price target on Semi to 75, saying its AI data center business is resulting in growth. And finally, Morgan Stanley resuming coverage of Qualcomm with an underweight rating, saying the memory shortage will create a, quote, tough environment. The stock is down. That name is negative by 1.5% in the pre-market. Let's stick with tech. Alphabet tapping the global debt market to fuel AI spending. The hyperscaler seeing record demand as it looks to raise $9.4 billion in pound sterling and Swiss franc denominated bonds. Bloomberg's Tassos Velsos covers global credit markets for Bloomberg News, and he joins us for more from London. Tassos, welcome to the programme. Let's just talk about what they issued and how oversubscribed that debt issue was.
Well, thank you very much. There's no two ways about it. It was a blockbuster. These are numbers we have never seen in the sterling market before. Just to give viewers some kind of backdrop, less than a year ago, we were talking about whether the sterling market is becoming irrelevant and whether investors should be looking elsewhere. Comes now Alphabet, and then we start seeing something like £30 billion of demand shortly before coming on air. That was the latest. So we are talking about massive demand across a number of markets that these companies haven't tapped before. That was the first time Alphabet, for example, is coming on the sterling market, and it's been something that we may not see again for a while, unless another hyperscaler, of course, comes forward and starts issuing big as well.
For those on the outside looking in who aren't familiar with the sterling debt market, specifically the credit market, and more broadly the sovereign debt market too, what is it that's unique about the sterling debt market that makes it the natural place to make an issue with a duration this long?
Yes, and we'll get to that because today was actually rather iconic. In very few, it's mostly insurance providers and pension funds. They have very long-dated liabilities. They need to cover that with very long-dated bonds. So this is why you tend to see issues more than 10 years long coming to the market. But what we have seen from Alphabet, and it's a bond that everyone's talking about, is the 100-year bond that they brought to the market. This is a bet that Alphabet will be around in one way, shape or form for the next 100 years to pay you interest every single year and mature, well after we've left this world.
Is this a good template, Tassos, for other hyperscalers that have to sell debt, given that it seems like there is ample demand from the pension funds and the insurance companies in the UK for something like this? In other words, is Europe going to be an increasing destination to finance US hyperscaler needs?
Yes, and everyone's ready for it, and everyone's willing to buy that as well. We've had 32 weeks of consecutive funds into Euro investment grade funds. Investment managers here are flush with cash. They want supply. There is some supply, obviously, from domestic players, but the amount of capex they want to see from hyperscalers is well beyond what you get from the entire debt market here. So all of this is going to be well received, and actually people have already started talking about who could potentially be the next hyperscaler to come to the market.
So there's a real question here, Tassos, going forward about how much we end up with a European market that has lots of money that starts looking at U.S. tech companies as an alternative to government debt in the United Kingdom and, frankly, to Europe more broadly. I mean, how are you seeing this price? Do we have any sense of that?
People have already started talking about the implications of it, because before this issuance, both Alphabet and previous issuances from other hyperscalers, we tended to view US and European credit as silos, and then thinking of the US being more linked to the performance of the US economy, for example, and Europe being more linked to the performance of the European economy. But now they're becoming much more merged. Now that the names that you start seeing in the market, we had lots of issuance from other US companies in Europe last year, but the sheer volume that we're going to see from hyperscalers are going to bring those two economies together. So suddenly, as a European credit manager, you have exposure to both the European cycle and the US cycle, which is something that for many people is going to be the first time they have to do it.
Do you think we're going to see another 100-year note specifically from another hyperscaler?
Well, this 100-year note received the most demand out of all sterling tranches. That tells you a lot. I think they covered the amount issued by 10 times. People just really went for it. So that is, that's a template for anyone else to do it. Of course, you put your money and your faith into a certain hyperscaler remaining at the top of their game and being around for the next 100 years to pay you interest and the principal of maturity. So it is a leap of faith to a certain extent, but today it showed that people are willing to take it.
Someone else's problem. Tassos, you know that. It's good to see you. Thank you, sir. Tassos Votsos there, breaking things down in the UK for us. The demand for duration, let's put it that way. I got an interesting note just moments ago. I thought it was a really good point. Let's pair the story with the Treasury, Besant and Walsh, together with what we're seeing from Alphabet, that if you do believe you're going to be starved of duration because the Treasury is going to bring things forward and tighten things up, then maybe it's these guys that are going to fill the gap.
I'm just thinking Alphabet has some really good bond traders in their C-suite because ultimately they are timing this market perfectly and giving them the supply. Not only do they have the 100-year piece over in the United Kingdom, but they're talking about 40-year debt here in the United States. So we're talking about long-duration assets that are filling a void that might be left by Treasury Secretary Scott Bessent and others.
We're going to see more of this in the year ahead. Lots more, and I keep going back to the conversation we've had with Oh Sung Kwon of Wells Fargo yesterday. The numbers could get bigger, and this could go on a whole lot longer than you anticipate because of the names and the companies with the balance sheets that are involved right now. They have the ability to do more and do more for longer.
I think it's worth continuing to ask, what is the end point, right? Because usually a CapEx cycle or an industrial build-out has an end point. And right now, I'm not sure anyone sees it or understands it, which is the reason why Reynolds Strategy put out a note this morning saying it is definitely a debt-fueled AI bubble. It will end, but not in the near term because there still is all this appetite. There are still questions, though. What will the large language models accomplish? How well will they be able to replicate human intelligence and fulfill some of these roles that are currently occupied by human design software and beyond? And I think that we have to keep looking at the science behind what this accomplishes before we start pricing in exactly what the benefits are going to be.
Equities on the S&P down by not even 1/10% in the bond market. Yields are lower by 3 basis points on 10s. 417. Up next, the latest round of resales data set to cross. We'll catch up with Greg Daco of EY in just a moment, and Mike McKee will break down the numbers for you. From New York City, you're watching Bloomberg TV. The opening about 60 minutes away, with equities pulling back by not even 1/10% on the S&P 500. The data seconds away. In the bond market, 2-year and 30-year yields are down. Yields are lower across the curve. We're down 5 on 30s, down by 4 on 10s. A lot of demand out there for fixed income this morning. The 10-year bond yield at 416, on 30s at 480. Retail sales data about to break with the number. Here's Mike McKee. Good morning, Mike.
Good morning, John. We're just waiting for the numbers to drop now. And I should remind everybody that the retail sales numbers are from the month of December. So they are a month behind, and they're basically trying to catch up at the various statistical agencies while they wait for these numbers to come down. The other number that's going to be important today is the employment cost index. And I don't know, it may be that my connection is slow, but I'm not seeing the numbers yet here. Hopefully they will drop soon, and it's just a glitch back in the servers in Washington and at the Census Bureau.
Mike McKee, we'll let you go because I've got the numbers in front of you. I imagine it's an issue on your end, a technical problem. Michael McKee there breaking down the results. So let's start with retail sales month over month. I'll give you the number and compare it to the estimate. So we come in flat. This is for the month of December at 0. We were looking for 0.4. The very closely followed retail sales control group comes in at negative 0.1%. That's the actual against an estimate of positive 0.4. Mike was talking about the employment cost index. That was a downside surprise. It comes in at 0.7% for the fourth quarter. The estimate was 0.8, but that's a downside surprise on retail sales. I talked about that bid into bonds going into this data. That bid sticks. We're down by 5 basis points on 10s to 4.15 at the very long end of the curve on a 30-year yield this morning. Yields are lower as well. We're down by 5 or 6 basis points to about 4.80. In the equity market, equity futures were a little bit lower, and that's where they stay, down by 1/10 of 1%. So this is the month of December. Retail sales coming in a little bit lighter than expected. It's the wrong kind of downside surprise, of course. A negative read. Do you fade it on the anticipation that we're going to get some tax refunds in the months ahead and this story turns around?
You know, this is difficult for me to really wrap my head around, and I want to see the internals of this because so many people had said that people brought forward the spending from the one big beautiful bill and already took it out on their credit cards. You see credit card outstandings that are increasing, that people are actually borrowing ahead of that. Also, just to add on to that, the revisions to the prior read were all revised downwards. So this isn't necessarily a catch-up or a catch down in terms of what the actual numbers were. If you take a look at the retail sales control group, the original reading was 0.4% for the previous month. The revision, 0.2%. So not only is it a negative read in this latest reading for January, but you're also looking at a downward surprise, or excuse me, for you're also for December, excuse me, you're also seeing a downside surprise for November. So this really does highlight some underlying weakness that I want to see more explanations to.
Yeah, the revisions aren't great. I look to those too, especially since we have a pretty boring number of unchanged. But this is the month of December. But Lisa, to your point, how many analysts have come on this program and said, we actually think that given the fact that this administration in Washington has been front loading and talking about the fact that you're going to get a massive tax rebate, that then they use that money, especially in the month of December ahead of the holidays. You're not seeing it today in the data, and that might be a bit concerning. And maybe why Kevin Hassett this week was talking about a little bit of don't panic when he talks about the employment number. Maybe don't panic potentially when you look at retail sales.
Payrolls tomorrow morning, about 24 hours away, 8:30 Eastern time. If you're just joining us, welcome. A bit softer than expected on retail sales. We were looking for positive 0.4 and we got 0.0. Greg Daco of EY joins us now for more. Greg, good morning.
Good morning.
What do you make of that downside surprise? How much weight would you put on it?
I think what's very interesting is that over the course of the past few months, we were trying to explain where the strength in consumer spending was coming from. And we were talking a lot about polarization. We were talking about the wealthy doing more of their fair share of spending. We were talking about credit growth. We were talking about a savings dip, all of which are real. But the reality is that the averages are softer than we had anticipated. So what this tells us is that even with a savings dip and the saving rate having fallen 2 percentage points since April, even with credit growth being quite strong in December, and even with affluent consumers still doing more than their fair share of spending, spending momentum is softening. Why? Because the labor market is softening. This is the key pillar to income growth and in turn to consumer spending activity. And we are seeing that labor pillar start to slow and show slower income growth.
It sounds like you don't think tax refunds are going to turn this story around.
Well, there was this proposition that tax refunds were essentially spent ahead of time, that people were banking on these tax refunds to spend. That's rarely the case. And even if they had done so, there was this question as to how much more fuel these could bring in the early part of 2026 with these tax refunds either being spent or used to reimburse credit or to replenish savings. I think that story is one that we're going to have to pay very close attention to because, yes, there will be larger tax refunds, but who gets these tax refunds and how are they being put to use in an environment where the labor market is in a deep freeze and where job opportunities are not as widely available as they once were and where income growth is slowing. Real disposable income growth over the course of November and into December, 1%. Consumer spending in November, 2.5%. And we're seeing, as of today, with the retail sales data, that momentum is slowing going into 26.
We spent more than 2 hours in this program talking about the boom of the U.S. economy and how we're going to see a run-it-hot type of environment right now with all of this hyperscaler spending. And then we see spending by the average consumer that comes in extremely disappointing and points to a completely different picture if you watch what they do, not necessarily what they say. How do these two stories get reconciled?
who benefits from the growth? That is the key question. We are in an environment where not everybody is benefiting from growth. We are seeing an environment where when you look at productivity growth, it's quite strong. And I think it's real. It's not AI driven. It's driven by businesses trying to do more in a high cost environment. So that is real. We're seeing the gains, however, benefit a few. It's a winners takes all type of environment. It's an environment where a lot of the gains are accruing to capital and not labor. If you look at real wage growth right now, and we're seeing with the employment cost index that adjusted for inflation, we're very close to zero. It's an indication not that the economy is not benefiting from stronger productivity growth, but instead that the gains are not split equally. They're going to profit margins, they're not going to real wage growth, and that means that income is under pressure and that we have this fragile foundation to growth when it comes to consumer spending activity.
Is there a breaking point for this? And I'm talking about an economic breaking point, not necessarily a political breaking point. We talk a lot about potential policies that are populist, that come and redistribute the wealth, et cetera, that could stem from this type of dynamic. But is there a market equalizing factor that comes from people not able to spend maybe on some of the goods that might be enabled by artificial intelligence? I mean, when does that sort of bridge gets broken through?
I don't know that there is one point at which something breaks, but the reality is that a narrow foundation to growth is less stable in terms of economic momentum. If you have more weight that is put towards higher income individuals that are doing more than their fair share of spending, then as a result of that, any type of uncertainty on the financial market front can lead to a pullback in spending from those individuals. And if the foundations in terms of income growth for the masses, in terms of consumers, are softer, then that means that they are more susceptible to pulling back and being more judicious when it comes to outlays. Same thing is valid on the business front. We often talk about a K-shaped economy on the consumer front. It's the same on the business front. A few businesses are driving business investment. It's not all businesses that are investing. And that means that when you look at profit margins on average, they're still very healthy and they are a good sign and a reassuring sign. But look at small businesses. They're struggling in the face of a number of these headwinds, and they're not driving growth as strongly as the larger businesses.
Is it too soon to extrapolate maybe potentially what also is going on here? Are prices too high? Are we seeing that people are just buying less? Or as we see in some of the consumer confidence reports and sentiment data, people are concerned about the job prospects upcoming, so maybe they're not spending as much. What do you make of actually what is going on in the psychosis of the American consumer?
I think the split between labor and capital is really an example of how businesses and consumers are feeling this economy. Anybody that benefits from strong income growth, whether it's via the stock market or via wage growth, is going to feel relatively well. But the masses that are not benefiting from these types of rapid wage growth and these types of strong job growth environments, they are the ones that are struggling. They are the ones that are being more judicious as to how they spend. From a business standpoint, they are the ones being more judicious as to who they hire, what skills they look for, what salaries they offer as entry wages, and how much growth they tolerate. And that is really the narrow foundation to growth that we're currently seeing. And that is why most people do not feel happy about the current economic environment, yet average growth figures are still relatively healthy.
What are you expecting then for tomorrow when it comes to the first clean read in a while for payrolls?
I don't know that we're going to get clean data for a few months in terms of CPI, in terms of employment. But what I do expect tomorrow, cleaner, is an environment where we see almost no job growth after revisions in 2025. Why? Because we're going to get the quarterly census of employment and wages that will show a strong negative revision to job growth through March of 2025. And the birth-death model that is being used to forecast job growth over the rest of 2025 will lead to job growth being very close to zero in 2025. Yes, that may not matter because we can argue that there has been a significant negative shock from labor supply and reduced immigration, but it does matter for everybody that is looking for a job and that is reliant on income as a source of spending. That weakness is something that we have to be very cautious of. The income story is going to be the key story in 2020.
Why are some Fed officials less concerned about that than others?
I think it depends on what the weight is that you put on the employment side of the mandate versus the inflation side of the mandate. If you put more weight on the inflation side of the mandate, which is what a lot of policymakers are doing right now, you're seeing an environment where essentially inflation is still above the target, around 3% when you look at the PCE gauge. That is a concern because they do not want inflation to become unanchored to the upside and not come back down to the target. If you focus more, as Governor Waller has been focusing, on the labor side of the mandate, then you're more focused about a potential downside risk to labor market activity. And when you look at a broad range of labor market indicators, they're not as reassuring as we may observe in some of the other data. If you look at how people are feeling about their job prospects, if you look at the hiring rate, if you look at wage growth, which I find to be the best indicator of underlying labor market demand, it's softening, it's not accelerating, and real wage growth is very close to zero. Those are signs that the labor market is softer than what might have appeared up till now in terms of payroll growth and the unemployment rate.
It's hard to argue against that. That's the Governor Waller camp as well. Greg, it's good to see you. Greg
Always a
Daco there
pleasure.
of EY on the labour market and on the retail sales data just moments ago. Well, that came in at 0.0. The estimate was positive 0.4. The team here at Bloomberg breaking down the numbers. 8 out of 13 categories posted decreases, including declines at clothing stores and furniture outlets. Sales at auto dealers also falling.
Yeah, and this is a reason why the comp sale, the control group of the retail sales, actually declined 0.1% for that key December month. The real question here going forward about how much this is just a blip versus exactly what we're just talking about with Greg, which is people aren't getting paid. So how are they going to spend, even if some of the numbers have been robust from individual retailers?
Bonds are rallying, yields are lower by 4 basis points. The 10-year at 4.16. With an update on stories worldwide with your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. Recapping the data we just got, delayed December retail sales coming in unchanged at 0.4%. Meanwhile, the retail sales control group coming in lower than expected at negative 0.1%, as Lisa just said. Elsewhere, ADP's weekly jobless claims show U.S. private employers added an average of 6,500 jobs per week over the 4-week period ending January 24th. Meanwhile, consulting giant McKinsey is handing over its $20 billion investment arm to Neuberger Berman. The deal caps off decades of Neuberger's management of McKinsey's current and former investment partners. It will see about 280 employees join Neuberger, with the deal still subject to regulatory approval. And Google parent Alphabet making a major push into the global debt market, issuing over $11 billion in sterling and Swiss franc denominated bonds. The sterling portion of the deal, which is the largest ever for a corporate issuer, attracted $30 billion worth of bids. The offering also includes an ultra rare 100-year note, highlighting the company's aggressive long-term commitment to AI. That's Bloomberg Brief, John.
Yahara, thank you. Thank you very much. Up next, Kristina Campmany of Invesco on the downside surprise for retail sales. Plus, Yahara's back with your morning movers. Shares of Coke lower after reporting a sales miss. That name is down by 3.8%.
Maybe a year or two down the road, it could become maybe a headwind. But for right now, you're unlocking all of this cash into the economy. So you essentially had trapped cash on balance sheets, trapped abilities of these companies to issue debt, and now they're taking advantage of it. And they could do this for years to come.
That was Eric Johnston of Cantor Fitzgerald a little bit earlier on this morning on the record issuance we've seen from some of these players and the record demand that this market is ultimately giving them. Equities at the moment on the S&P 500 just about unchanged. We just received the first data point of many for the week, and it wasn't good. The December retail sales number coming in much softer than expected and unleashing a rally in the bond market. Yields down by about 4 or 5 basis points across the curve. 10s at 4.16, 30s at 4.80. The opening bell 42 minutes away. Let's get you some single names as well. Your morning movers with Yahira. Hey, Yahira.
Hi, John. Coming into earnings, Coca-Cola shares were up more than 12% in the pre-market. So the bar was high and it did not quite meet it. Shares are down 3.7% after the company's 2026 sales outlook came in just a shy below Wall Street estimates. As the beverage giant continues to grapple with people just drinking less soda, it points to the challenges facing Henrique Braun, who is set to take the helm in March as CEO. Meanwhile, moving on to the chip manufacturer TSMC, shares are up 2.3% after revenue in January surged 37% as the hyperscalers are set to spend an eye-popping $650 billion in capex this year alone. TSMC also planning to spend big, earmarking $56 billion in capex this year as well. And we end on Datadog. This is one of the companies that had been caught up in the software sell-off last week. It is still off about more than 40% since its November peak, but it is making some strides. Shares are up now 15% in the pre-market after beating fourth quarter expectations. And while its full year outlook did come in a touch lighter than expected, analysts do view it as conservative. John?
Hey, Yahara, thank you. Appreciate it. Thanks for that. As we count you down to the opening bell, retail sales behind us. This is what the calendar looks like now for the week ahead. Look out for the Fed speak from Halleck and Logan at 1 p.m. Eastern time. We'll also get a White House press conference, plus Ford reporting earnings after the closing bell. Wednesday, the payrolls report just around the corner, plus results from McDonald's on Thursday, jobless claims on Friday, CPI. Looking across that calendar, yes, the data matters, but McDonald's in focus just a little bit more now, just to get a better idea of where this consumer's at into the new year.
Yeah, with Coca-Cola really pointing to some of the weakness, particularly in low-income consumers. They really spotlighted that with one of their executives talking about how you continue to see that pressure. Do you see that? Interesting, Coke raised their prices an average of 4%. Pepsi dropped their prices to try to increase volume. It gives you a sense of what the backdrop is from the consumer.
So let's look at the next 12 months. Kristina Campmany of Invesco writing, in many ways, we're at a crossroads. And the next few weeks should be telling for the first half of 2026. Kristina joins us now for more. Kristina, good morning.
Good morning. Thanks so much
That wasn't
for having
a
me.
nice data point on retail sales, and thanks for being here. What was your reaction to that?
Look, I think the data remains very noisy, and we know we're continuing to balance the inflation in the labor market, but we know that there's this bifurcation of the consumer, and we're all sitting here talking about the K-shaped recovery, but we know that there's a lot of weakness out there in the labor market. It feels like we're back into this waiting for the next shoe to drop moment of you just aren't seeing labor creation, and if there's not job creation, it's hard to see the extent of a robust economy continue.
You think
Just
that
haven't seen it.
we might actually get some clarity, because we have been in this sort of, what are we looking at? How are these numbers really shaping up for quite a number of months? Why is this potentially an inflection point that could give us more clarity?
So I think that we're getting to this point of, does it break, or can we push through? We have some of the impacts of the fiscal and the big beautiful bill that should come online in first into second quarter. But the labor market, I think the market has kind of gotten acquainted to maybe the break-even payroll really is this 0 to 50K number. And I think that that's in the dialogue, but I don't know if the market's ready for seeing a negative print or seeing that is still reacted to as a more negative. So I think the labor market really holds the key here of where do we go from here? And again, if you take a step back, you've never been able to maintain this level of growth without job growth.
Can the rotation that everyone keeps talking about continue without seeing the commensurate economic data, given that a lot of it's predicated on a whole host of spending that, frankly, the debt market is super happy to keep financing?
But you guys spoke about it earlier this morning. I mean, so much of the growth in the U.S. economy has been driven by the hyperscalers and the hyperscalers alone. And you have the administration focused on affordability and talking about pushing out $1,000 per consumer, per family. So there's this big bifurcation, push and pull of where growth is really coming from. And again, I think the critical point comes back to, can you have labor market growth to then sustain it on a longer run basis?
When you see retail sales like this, and individuals before this were saying actually people were using the basically future tax rebate they knew they were going to get to spend. Well, they clearly were not. Why do you think they're actually going to use it when they get it? Potentially, is that just going to go to John's point earlier this week and last week, talking about electricity prices or maybe paying down some of their own debt?
I think that there's definitely, the consumer has been, we've seen this since COVID, the consumer is much choosier, right? And they're savvy about where they're spending and how they're spending and rotating around as needed. But I think there's a lot of angst in the market and in the economy of like, what is the next shoe to drop? Do I have, okay, we're optimistic about better tax refunds and you have the tax bill that's coming through, but like things feel on unsteady ground more broadly. So it doesn't shock me that the consumer is taking a pause, right?
What are you expecting from jobs tomorrow?
I think the risk, again, I think what consensus is like 68, 70,000, right? Yeah. Like, I think in that ballpark, the risks are probably a weaker number if you have more drag from government jobs coming, from the delayed retirements or push-outs from DOGE of early last year. But again, I think when I look at the labor market, the risk, I think, is that we have more weakness in the medium term and that you have a market that is more reactive or overreactive to a zero print when you say, well, again, if the break-even number is only 25, having a 0 or a negative 25 is actually not that out of the realm of possibility.
This program started so bullish. I just want to reflect on that. It started so bullish on the US economy and the president was talking about 15%. No one thinks 15% is going to happen. But ultimately, there was 3 big reasons for that. Refunds, the tech capex, the monetary policy, the rate cuts we've already seen, and then it's one data point from December, and all of a sudden it's all bearish again. It's just like that.
It depends what side of the story you're talking about. Are you talking about the AI story where people can still be very bullish? Or are you talking about the real economy, which seems to be completely unaffected right now? Or not unaffected, I'm being dramatic, but not necessarily seeing the scope of some of those gains.
And that just really shows why the president is having such a hard time. We are seeing tons of money being spent, but only from these hyperscaler tech companies and the angst within the consumer. You're not seeing them spending. They're concerned about their jobs, and they probably are concerned about the tech companies driving up their electricity prices and maybe also making their job obsolete.
GDP could be good to that point, but the kind of numbers that move the dial for the polls and the midterms might not be. It's good to see you. Thanks for being here. Kristina Campmany of Invesco. If you're just joining us, welcome to the programme. Futures just about unchanged on the S&P 500, but the data we got about 25 minutes ago just supporting the bid we saw go into bonds in the last few hours. Bond yields are down across the curve. We're down about 4 or 5 basis points on a 10-year, down almost 6 on the 30s, 480 at the very long end of the curve. Coming up tomorrow, we'll catch up with Steve Englander of Standard Chartered, Lisa Shallard of Morgan Stanley, Gagi Chowdhury of BlackRock, and Mike Gapon of Morgan Stanley.